Welcome to the Market Huddle with Patrick the Content Machine Ceresna and Kevin the Macro Tourist Muir. So grab a drink, get comfortable, and get ready for a deep dive into the markets. Take it away, guys.
It's June 7th, 2019, episode 31. I'm Patrick Ceresna.
And I'm Kevin Muir. Thanks for joining us this week. This week's guest is Steve Aniston, better known as Stevie VIX, which promises to be a lively discussion about the markets and the mistakes the Fed is making. And then for the second part, I give a lesson in yield curve trading, what it is and how to do it.
All right, well, let's jump into it. Lena, why don't you hop on here and tell us about this week's beer sponsor?
We're drinking Society of Beer Drinking Ladies by Henderson Brewing Company.
Ooh.
So it says, this collaboration with the Society of Beer Drinking Ladies is deep golden with a red-orange tint, loads of upfront citrus flavor with notes of clove and banana close behind. Light-bodied and effervescent with a tart, dry finish. What's not to love?
Oh, well, you know what? I want to know what the society is drinking, so let's see.
And it's blood orange, says
Let's crack her open. You know what? That's not as girly as it sounds.
No, it's actually pretty. It's actually really good. I thought it was gonna be way.
Yeah, I honestly thought this. Like for some reason, I was picturing. Like, look at me stereotyping things, but I was.
Yeah, I know, Patrick. I'm offended.
You should be offended.
That you think that women don't like as. You imply that girly beers might not be as tasty as manly beers, and
I've been proven wrong. I am.
Not only that, you're the one who's picking all those sours all the time. So.
Oh my God. Anyway, you know what? I actually like it. It's thumbs up for trying this out. What do you guys think?
It's a good summer beer.
Yeah, I think it's good. Those Society of Beer Drinking Ladies are on to something.
All right. Well, Kev, let's jump into it. Give us your legal disclaimer.
Okay, clients and employees of East West Investment Management may hold positions in securities mentioned in this podcast. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. For more information, please visit eastwestfunds.com. Side effects of too much market huddle may include high tooth-to-tattoo ratio, wineria, and or bull chap, which is when a short seller rides a rally so hard the losses literally chap the trader's ass.
All right. All right. Thanks for sharing there, Kev. Let's jump right into it and get Stevie on here.
We're pleased to have with us today Stephen Aniston, better known as Stevie VIX. Now, Steve is somebody that I've kind of admired and watched on Twitter because he's not one to shy away from giving a good opinion. I laugh in terms of when I see things. I see, like, I'm going to quote a couple here. He says, nobody gave the Fed a mandate to generate inflation, period, full stop. The Fed is out of control and needs to be given more detailed instructions from Congress. And when I saw someone with such a kind of market huddle extreme view, I thought to myself, we got to get that guy on. So it's a pleasure to have you on, Steve.
Well, thank you guys for having me. You know, a big fan of the podcast and the Macro Tourist blog as well.
Well, thank you very much. So for those who don't know, Stevie VIX is actually specializes in VIX futures. And you can, if you want to learn more about his product that he offers, it's vixcontango.com. So VIXCONTANGO.com. And you originally got your start. You worked at Goldman Sachs and Royal Bank of Scotland, and you were telling us you were a data engineer and or data scientist, I'm sorry, and that you kind of specialize in trading VIX futures or VIX or options or volatility in general. So what do you got on your mind? What do you want to talk about today?
Yeah, so even though my website kind of specializes about volatility and trading the VIX ETFs in particular, giving people kind of trading analytics for it, I also do a lot of fundamental analysis at Goldman and at RBS. I was kind of at places where I did a lot of valuation work and I created a lot of algorithms to do valuations. So what I discuss is basically what drives volatility. What are the fundamental drivers of volatility? And so today I would like to talk about basically what my fundamental view of the market is and where I think things are going in terms of volatility.
Okay.
And what's driving us there.
Right. And I see you might be more in my camp than Patrick's camp, because I see the first slide here. You say the 2019 market outlook, the battle to contain inflation. So I take it that you think this recent scare that everybody's worried about deflation and and rushing out to buy bonds, you view that as it might be unwarranted?
Yeah. So I want to start out with basically the biggest unreported story that is happening right now. And if we can go to the next slide, is basically all of the once Trump got elected, he kind of ruined the whole agenda of the Democrats. I mean, they were planning on to raise the wages, the federal minimum wage, which hasn't been raised for 10 years, which is the longest period that hasn't happened. And so when he came to power and, the Republicans took power, that obviously wasn't a choice anymore. So what happened is all of the blue states, all the Democratic states, they started passing their own versions of wage hikes. So they basically took the Bernie Sanders plan and they started passing these plans, in California, in New York, in Massachusetts, in Connecticut, where I live. So in this chart, I basically put together all the plan, all the state wage hike plans, and while politically Trump tries to take credit for all the wage gains that we see at the bottom end, this is kind of one story that has been reported, is that the wage gains have been going up, especially at the bottom end. They attribute it incorrectly to the tax cut. The real reason for that happening is this Democratic legislative win, so to speak, at the state level. So if you look at this, about 170, states covering 170 million people in the U.S., right, have implemented these minimum wage hike plans, and they literally raised the wages about like $1 per year, right? So, in California, it's $11 this year. It went up to $12. Next year, it's going to go to 13, and so forth. So if you average it out, right, you have about the minimum wages goes up about 4% in 2018, 5% in 2019. Actually, the biggest crush of wage increases happens in 2020, where it's going to be 8%, right? And then in 21, 5%. So you have this massive increase in wages at the bottom end, which is about 30% of the of the employees in the U.S., are basically minimum wage workers. So that's basically pushing wages high. That's why we see these 3.5% readings in the wages, and that is going to continue to increase into next year as well.
I think that's amazing. I didn't realize that 2020 that's where the bulk of the gains are going to come. Like, I'm looking at your chart here, and 8.4% in 2020. That's a big increase. Like, that's even Patrick's going to have to admit that there's some inflation there.
Yeah, I mean, it's very big. You've seen already how this 5% number is equivalent to roughly 3% for the average hourly earnings on the jobs report, right, for the total number. And so I mean, basically, when you take the when the minimum wage goes up, then all the wages after that go up as well, right? So it tends to spread upwards into the workforce.
Right. It's like it's pushing from the bottom, right?
Politically, they aimed for the biggest increase to happen in 2020 because that's when the election is, right? They want to go there to win the election.
Oh, yeah, that's right.
That's interesting. And the best way to fight this minimum wage increase is to raise interest rates, right? I'm joking.
You would think.
No, but I mean, anyway. Go on with your presentation.
Yeah, so to me that's kind of a big story. It's an underreported story, and the reason why it's underreported is because it's happening at the state level, not at the national level, and the U.S. media generally tends to focus on national level topics. So let's go to the next slide. So this basically these massive wage increases, which we haven't seen for the prior 10 years, right? This is kind of a unique event happening right now, right? I think it's going to work to compress the operating margins of the S&P 500. I mean, we've seen, as you see on the chart, just a massive increase over the years, and particularly in the last 2 years, there's been a big jump, and that is directly related to the tax cut that Trump. But what I think is going to happen not only next year, but I think going forward over the next 10 years, you're going to see, I think, a dramatic change. So far businesses have always won against labor, right, in the U.S. government. You've gotten tax cuts, wages haven't gone up, right? So operating margins have increased over this time. I think what we're going to see going forward is that, wages are going to go up. Taxes are going to go up. Tariffs are also taxes. Tariffs are going to go up. So I think margins are going to come under significant pressure. And it's not going to be just a one-year event. I think it's going to happen over multiple years. I think, this will probably shock you. I think basically Trump is going to be the last Republican president, probably for the next 10 years. And, we're going to see, we're going to be a big landslide victory by the Democrats
Really?
In 2020. And and the whole thing is just going to turn out very big. So the real big battle right now politically is basically, is Biden going to win, or is the left wing going to win with somebody like Bernie or Bill de Blasio or Elizabeth Warren or Kamala Harris, right? So really the battle right now for the governance of the U.S. after 2020 is really happening in a Democratic
I
Party.
I find it fascinating that you make that point, because from a lot of the different reports that I've seen, there's a lot of people that are putting some reasonable probabilities that Trump is going to get reelected. I mean, you don't think this is going to happen at all, right? Like you legitimately believe the Democrats are going to sweep here?
So let me just give you some background into. I do a lot of political predictions because I'm good with stats and data as part of my work, and so I did predictions for the 2016 elections and for the 2018. So in 2016, I went into the election saying that Trump is going to win and there's going to be a win by the GOP. At which point half of my subscribers walked out, right? but I basically said the best case scenario is for Hillary to lose with be a split vote, and then Congress, the House, which is held by Republicans, will make Trump win. Then in the 2018 election, everybody thought the GOP is going to hold the House, and I kind of called the Democrats will win the House. I even called the seats like 240 seats or 235. I almost called them to the seat, and I also said that the Republicans will win the Senate, right? Which is a very unconventional view, because most people thought either there's going to be a Republican win across the board or a Democratic wave across the board, right? So I also called that pretty well. Now, why am I telling you that that Trump is going to lose basically by a landslide? The key state here to focus on is Texas. Trump won Texas by 800,000 votes. Beto O'Rourke, or Ted Cruz, which is a Tea Party candidate and the closest thing to Trump, in the Republican Party, won by only 200,000 votes 2 years later in 2018. So there was a 600,000 vote difference from Trump to Ted Cruz. So what's happening is you have a huge migration from California to Texas because housing prices are very high in California, which is now accelerated by the SALT cap. So you have about 100,000 people moving from California to Texas. And you have to understand that basically a moderate Republican, right, in California is really a left-wing Democrat in Texas, right? So it's basically a Republican in California has the same belief system as a Democrat in Texas. They're fiscally conservative and they're socially liberal, right? So that is skewing Texas. Basically, Biden just came out. There was a poll that came out, Biden leading Trump by 4 points, and every other person was within 4 points of Trump. I mean, that is unheard of. And basically the numbers are within 100,000. they're very, very close. You have 2 more years of migration, and Texas is turning blue. So it is going. That's not only happening in Texas. I think the South Cap, you saw how it turned. All the Republican counties voted for Democrats. The South Cap was a very big mistake by the Republicans, and basically there's not enough votes for Trump. I mean, he barely won in 2018.
I mean, he called Cruz. What was his nickname for Cruz? Like Lion Ted, or something like this. Like
Lion Ted, yeah.
I mean, at least for me, like I think Trump, looking at Cruz's numbers, it may not be reflective. Maybe, I mean, you might know better.
Okay,
yeah.
1 second, Patrick. I'm going to jump in here because the last thing we need to do is get into a discussion about politics, because it's one of those can't wins, and you should have known that. So, Stevie, I have a question for you. If you are correct about the probability of the Democrats winning, and needless to say, I think you think that that's a much higher probability than the market believes. Do you think that will be or what do you think will happen to the stock market? I don't want to put words into your mouth before
I'm going to continue here with the story. So basically, if you have a stronger presence of the Democrats in Washington, and this is going to be a more liberal, this is no longer your Clintonian Democratic Party, which is pro-business. This is a more pro-labor party now, right? So you're going to see tariffs increase. Maybe tariffs made a border-adjusted tax, right, is going to come back in some form. But you're going to see corporate taxes increase, right? And actually, I want to talk about this because this is an imminent thing. Nobody's really following that story. But basically, Trump and Pelosi have had this conversation about infrastructure. And when you look at the actual negotiations, basically what the Democrats want is they want to bring back the corporate tax level to 25%. They want to raise the corporate tax. They want to reach back to the pre-tax cut levels to 39%, and they want to bring back the alternative minimum tax, right? So basically, they want to raise. They want Trump to raise taxes. Now why is that happening? Is because the budget deficits have really exploded way beyond the projections, right? The revenues coming into the Treasury is not enough, and so
it's Stevie, it's actually ironic that the Democrats are being the ones that are worried about budget deficits, but it's always the party not in power that's worried about the deficits, isn't it?
Well, the Democrats have actually a good record on budget deficits. I mean, Clinton had surpluses. Obama went from deficits to basically closing them up, and then Trump is blowing them up again. So they have the Democrats, they like to tax. I mean, there's no doubt about it. They like to raise taxes. Obama put an investment tax. That was a big reason why the deficits declined. So that's not unusual. But what I'm trying to say is, like, basically the Treasury right now is running extraordinary, measures. There is a debt ceiling coming up. They're going to run out of money basically in the August-September timeframe. And so they have to pass a deal to Pelosi. And so if Trump, right, as you see, Trump always backs down, but guess who's going to back down to this time? Before he had to back down to Paul Ryan and all these guys, and they wanted more tax cuts. Now he has to back down to Pelosi, which she wants corporate tax hikes, right? So what people don't realize is that this tax code is not going to stand. And that's the primary source for my bearishness. This tax code was voted on by 50 Republicans through reconciliation procedure. It has failed basically the Byrd rule, how much it increases the deficit, right? And so they're going to come back with a tax hike. This happened under Reagan as well. He passed a tax cut, and a few years later had to roll it back. So I think this is kind of what's happening, and what's going to drive the earnings growth in the stock market to come to an end.
Right.
Okay, now if this happens, when does the market start to figure this out? At what point do they start to discount your worry about the tax cut getting rolled back? Do you see this as this fall, or is this like a story for this year or next year?
No, it's absolutely a story for the summer. So if you go back to the previous slide, so I just want to show you, why the market has done so well is because we had this big growth in earnings over the past 3 years, right? 16%, 20%. You had oil going up. You had the big tax cut, right, driving earnings. So that drove the market higher. It was very bullish in 16 and in 17, Then in 2018, I got bearish because I looked at the tax reform and I said, you know what? This is going to explode the deficit, right? And this tax code is not going to stand. So then the Republicans are going to want to take it, they're going to want to, rewrite this tax code, right? So the earnings going forward are going to get affected. If you raise the corporate tax rate, right, to 25%, and you raise the investment taxes, you will see, earnings are going to decline, and you're going to hit, the market is going to get a hit, because people won't have money to invest in. So let's go to the next slide. So this year, when talking about earnings, it's very similar to 2015. What's happening is earnings have fallen off the map. You see the 2000, the first quarter earnings quarter over quarter were up only like 2%, right? And then, they have 10% projected. That's going to come down. But what has happened is the analysts have put all the earnings in the fourth quarter, right? So they're basically projecting we have this miraculous earnings growth that's going to happen in the fourth quarter, which statistically is like basically unparalleled, right? If in the chart below, crazy. You see how it's 44% growth. 44%. I mean, we didn't have it in the last couple of years. We have tax cuts. You only have this type of growth when you come out of a recession, right? We're nowhere near. We're not in a situation like this. So this happened in 2015. They tend to pack the earnings, and then they start to lower them right before the third and fourth quarter come. And if you remember in 2015, what happened is the market kind of held up through the summer, and then in August we had a huge collapse. And everybody tries to attribute the collapse to China, which is one of the causes. But the bigger cause was that analysts had to severely downgrade their earnings, and we're going to have the same thing happen this summer, because this 44% growth is just not going to happen.
I like where you're going with this. This ruins Kevin's narrative, but anyway.
For sure it does. And that, you know what? I love hearing the other side of the argument. So how low do you think we go, and how bad does it get, Stevie?
So I'll kind of discuss this. I have a different view of how people analyze. So, for example, I don't think tariffs are bad for the U.S. economy. I think they're bad for the Chinese economy. They're bad for the Mexican economy, because basically they have to lower prices, right? And they have to compete. But that is good for the U.S. economy. I view any factory that goes from China or Mexico to the United States, I view that as a good thing for the U.S. economy, right? So I don't view tariffs as a bad thing. I also don't view tax hikes in the current place as a bad thing either. I thought tax hikes give income to savers, which then they spend. So I'll discuss this a little bit more later. But basically, I don't think we're in like this. A lot of people see this giant recession coming in the future. I see slower growth, but I don't see a giant recession. What I see is a market that is very overvalued, right? I see earnings that are very high, right? So what I see, once we slow down and once taxes get raised and once tariffs get put on and once wages go up, earnings basically decline in a big way, right? They're leveraged to these effects. So earnings can drop dramatically, right? The only reason why earnings growth is so strong is because everything the government does has been to help the market. Now imagine you have a government that does not help the market, right? Then earnings are going to collapse. And, even if you have a mild recession, or if you just have, more aggressive regulatory stance by the U.S. government, earnings can go down in half, right? That's why I have this blue line. So they can go from 150, 160 to about 80, right? So let's go to the next slide. So if you look at, so not only do we have kind of prospects of earnings going down because of government, change, the government philosophy of the United States changing, but we also have a market where earnings are have very high multiples. So here I have presented to you the trailing multiple on the top and the forward multiple at the bottom, right? So on a trailing basis, we're at about 20, right? So we kind of peaked out at around 25 in January of 2018. That's why I kind of say that the bull market ended there, because that's when investors were willing to pay the most for a share of earnings, right? And since then, that has been declining. And the story is very similar on forward earnings. Now, there is kind of arguments between forward and trailing earnings. Basically, both are important for the market. Like if you say I can make $100, but then if you don't deliver anything, right? I think people are going to sell your stock, right? So people look at trailing earnings as validation that the projections are valid, right? So both things matter, and on both measures, we're at basically at the high end of the range, historical range, right? We're like 95 over, 95 percentile. So if you look at the forward earnings map, I have it in yellow, right? You saw how through much of the recovery, the market traded at much lower multiples, right? 12, 13, that's where usually markets are. 15, this stuff where you see 16 and 17, this is very high valuations, and then even got as high as 19. I mean, that's kind of ridiculous. So, you get, the way you got to think of it is the valuation is a function of earnings, right? Like if you have higher earnings growth, if earnings grow 20%, you can put a higher valuation, right? So that made sense the past 2 years because earnings growth was 20%. But if earnings growth goes negative, or goes to zero or goes to 5%, all of a sudden the multiple has to collapse. So this is why markets are so volatile. You not only do you have collapse in the earnings, but you also have collapse in the multiple. So there's a double whammy that comes in.
Fair enough, Steve. We're gonna have to. You know what? We're gonna save it for the after hours. This is terrific stuff. Everyone, before we go, we're gonna sign off for Stevie at this point. But before we do that, I just want everyone to know where they can find more of your stuff. First of all, tell us about your website, where they can follow you on Twitter. And I must say, you're a fun Twitter follow because the reality is that you do not mince words. You make me laugh all the time with your kind of your tweets, and I think everyone should kind of follow you. So why don't you give us both your website and your Twitter handle?
So my website is vixcontango.com, and my Twitter handle is @vixcontango. I mean, Twitter, when I first saw Twitter, I thought, I can go and complain about, my innermost thoughts, and everybody can hear it. That's awesome.
Anyways, thank you so much for coming, Stevie. And for those who want to hear more, make sure you stick around to the after hours.
All right. Lena, take us in here.
No,
Kev.
Lena. Oh, sorry. 1 second. I didn't mean to interrupt there. Try it again. Let's just go from here. Let's just run it, okay?
Yeah.
No, I want Lena. Leave this in. Let's go. Come on, Patrick.
Okay, Kev. Understanding the Steepener. So many of our listeners have been following you, and so obviously there's a lot of people out there that talk about the bond markets, but there's different ways to trade it. There's obviously those that play directly long, but then there are those that play the shape of the yield curve. And as interest rates are changing on different parts of the curve, often it's a far less risky proposition on playing the way the curve will shape as opposed to taking direct exposure into the bond markets. Am I summarizing that right, basically?
You got it right, Patrick.
Right.
But wait, before I got to interrupt you, Patrick.
Oh, there you go. Okay.
Yeah.
So number 7, are you at?
No, I'm not a Tony Greer style.
All right.
So let's talk about the Steepener, because
yes.
I always laugh. People tell me that they're bullish on fixed income, and you ask them
like me.
Where? Yeah, and you're just like, I own the TLT.
You laugh at me. You laugh at me all the time.
Well,
that's okay. I made some money on this trade, so you can
did
laugh
make some
all
money.
You want.
You're absolutely right. And the TLT has done well, and it's been a great trade. And for us bears, it's been painful, and it's not been a very good trade. But what I want to do is spend some time talking about the yield curve, because there's different ways to play it, and those will actually affect, and in understanding how you can play the different parts of the yield curve could make you a much more profitable trader. So before we start, let's just talk about steepening and flattening. And you always hear people talk about a bull steepening or a bear steepening or a bull flattening or a bear flattening. Patrick, I think that I'll let you do this part of it. Why don't you explain what they mean when they talk about those different moves?
Right. So thanks for prepping me on this one. But
Yeah, no, I just throw you to the wolves, buddy. Throw you to the wolves.
well, okay. So it's all about whether or not it's the short end of the curve that is the one that is moving faster than the long end, correct? And so there's different ways, because if the long end of the curve is running away, it's going to be the one way, and then if it's the short end coming in, it's the other, right?
Right. So if you get a situation where the bond market is up, but the short end is up more in terms of price, meaning in yield collapsing, that is a bull steepening, meaning that the short end is going down faster than the long end.
Right.
And let's just take like a bear flattening. That's where the bond market is going down, yet the front end is going down in price, meaning that the yield is increasing faster than the long end.
Right.
Now, why does this matter? Well, it matters a lot because if we go look at the move over the past week, and you talked about the fact that you were long the bond market. Yeah. You talk about the fact that you were long the bond market and you thought you had a good week. Well, I'll tell you, the people that were long the twos had even a better week.
Well, it depends on the magnitude of leverage, though, because on a cash
because
basis.
because this is the point that we can trade it on a yield curve equivalent, so we can make it so that 1 basis point is the same. So although the bond market was up this week,
on a basis points basis, you're absolutely right.
So let's go to the next. This is the slide of the TLT, which is the kind of the non-fixed income guy's way of trading bond market. And that's fine. There's nothing wrong with that. And for a lot of investors, that's terrific. Now, what I'm going to try to do is kind of open your minds to the idea that there might be other ways to play it. And this is what we're looking at now is the fact that this is the last month of trading in the TLT.
Yeah.
And you'll see it's run from 125 to 132, and it closed at 131 roughly. I did this as of yesterday, so just be aware that that's what we're looking at. So let's go to the next chart, which is the U.S. 2-year Treasury yield over the past month.
Which I can't fucking believe this. Like this thing, we saw a collapse of over 50 basis points in a month, or near 50 basis points in a month. Like unbelievable. Unbelievable.
Dogs and cats living together, kind of.
Like but like it's under the circumstances. Like I understand if shit was really hitting the fan, that we would see 50 basis points wiped out of the 2-year in that kind of order. But I don't really see where the bond market is getting the data from that is causing them to do such a massive reprice. Like first, I was long the 2 years, so I have no problem saying thank you very much for the profits, but I was flabbergasted by the sheer amount of move that we saw. That's far beyond what I thought I was going to get. Yeah,
like we had the S&P 5% from off the all-time highs. Credit spreads fairly well behaved. Unemployment sitting at all-time lows. Like there's no real,
I'm far more bullish bonds than you, but I'm shocked by this.
I'm scared even you. So anyways, let's keep going.
I'm not scared. I'm just shocked. Anyway,
well, I think that you guys have all talked yourselves into this.
All right, quickly.
Honestly, I do believe this. And all hats off to you because I've been wrong and you guys have been right. The question is whether the Fed will follow it. And this is where we're going to get into looking at what you're really betting on as you go here. And maybe you should be looking at different ways to play this trade.
Right.
But let's just keep going here. So the 2-year, go back one slide. The 2-year went from where were we a week ago?
2.25 down to 180.
Yeah, but a week ago we were 215 down to 180. And then we go look at the 10-year, and it went from 230 down to 212. So it gave up less in terms of basis points decline.
On a monthly basis, though, it gave about 50 basis points. About 40 basis points. So now we went from 245 to 205, right?
Yeah, okay. But let's go to the next slide here because I want to show you. So I went and put together the numbers for everybody. So the May 28th, I'm just talking the last week. Let's just look at the last week. The U.S. 2-year, 10-year yield spread was 13.72 basis points as of May 28th. Okay? On June 5, a week later roughly, that had risen to 27.58 basis points.
Right.
So it was an increase of, 14 basis points roughly.
So just so that technically to express this, when I pull up the 2s, 10s here, we're talking about this jump right here, right?
Right.
Right.
So this is what I want to show you how you can play that. So let's go look at two different futures. I'm going to look at the U.S. 2-year note future, and I'm going to look at the 10-year ultra future. Now, everyone's going to ask, why aren't you using the TY future? Why are you using the ultras? And the reason we're using the ultras instead of the TYs is because the TYs, when you look at the cheapest to deliver, it's actually less than a 10-year cheapest to deliver. What does that mean? That means that the bond it's tracking is not quite 10 years. Where the ultras actually have a bond that is tracking, the underlying deliverable kind of bond that you deliver into that futures contract is much closer to 10 years. So it's much better looking at that as opposed to the what they call the 10-year future. So Can you go back one slide, Patrick?
Yeah.
So on May 28th, the 2-year was 106 and 31 and 3/4 30 seconds, and the ultra 10-year future was 135 and 4/30 seconds. Kind of June 5, they both had rallied. The 2-year note future was 107 and basically a half, 16 and 3/4 30 seconds. And the ultra 10-year had risen to 136.20 30 seconds. So the ultra had actually risen more. So let's go to the next slide.
Actually, let's just pause for a second. I just want to let our listeners. So a lot of our listeners are used to the stock market where everything is now
decimals.
Fractions, and the thing is that
everything's decimals.
Yeah, but prior to I think it was at the turn of the century, but prior to that in the 90s and 80s, a lot of stocks actually were still quoted in fractions.
Sure.
The decimals,
I remember, Patrick. This is I remember trading eights.
Yeah,
and then
agreed.
And then teenies, which were 30 seconds, and then I don't know, whatever.
So a lot of our listeners that are used to everything being in cents, that's not the way it was for the last century, right? Everything was fractions. And so the bond market is the last market that has stayed fractions as opposed
to holdouts.
They're holding out, and
it's so dumb. 16 and 3/4 30 seconds.
That's
just batshit stupid.
Everything is in a fraction to the 30 to 32, and so when you hear say 107-16, it's literally 107 and a half. Right, because it's 16 is half of 32, and
Patrick, I'm proud of you that you figured out 16 is half of 32.
You know what? It took a couple beers, but I'm here. But the point I thought our listeners need to know, because they hear all these numbers and they need to know we're talking fractions, right? Okay, so let's go on.
So let's go look here. From May 28th to June 5th, let's go look at the net change. The U.S. 2-year, 10-year yield spread moved up 14 basis points roughly. The 2-year note future went up 0.515625, which is basically $0.50. And the ultra 10-year note future was up $1.50. So it seems like if you were trading this, that the best bet was to buy the 10-year note future, right? That's what you basically argued earlier, was that you were better off buying that.
Well, again, it depends if you're talking basis points, if you're talking dollar for dollar being invested in just pure bonds.
Right. So let's go to the next slide, because I contend that idea that you were best off owning the 10-year note future was wrong. The best trade was to own the 2-year note. And in the reason for that is it actually declined 27 basis points, while the 10-year only declined 13 basis points.
Right.
The curve steepened. And that was a bull steepener, meaning that the short end went down faster than the long end went down. Right. Now, let's go figure out how we trade this. Let's go to the next slide. So here, before we do that, this is the picture of the actual steepening of the curve that we see. This is the 2-year, 10-year spread. You see that it used to be 13. It spiked up to 30 even, and is now roughly 26. Let's go to the next slide.
All right.
Patrick, you there?
Oh, yeah.
Can you go to the next slide, bud?
I did. It's a 2-year treasury note here.
I don't.
What do you need?
Oh shit! You're gonna have to edit that out, Lena. Sorry, write that down.
Lena, we're at the 123 mark.
Sorry, Lena. So this is the 2-year Treasury note future. We can see that the increase, it went from, those are the numbers from 107 to 107.5. And then if we go to the next slide, we'll see the U.S. 10-year Treasury note future. You'll see it going up $1.50. Now, how do we figure out the ratio to hedge between those two so that the basis point change is the same? This is where we go and we plug it into the old Bloomberg, the trusty Bloomberg, and we get this point where we work on creating what's known as a 1 basis point value equivalent. So we get the hedging ratio between those two.
Right.
And we realize that for the basis point to be equivalent, 100 Treasury note 2 years, we need to go and hedge it with 36 of the ultra 10s.
Right.
And if we do that, we in essence get a situation where each basis point value on either the 10s or the 2s will be the same. And in this case, it will be every basis point is equal to $4,200 roughly. Okay,
right.
You got that, Patrick?
Yeah.
I know.
Well, but let's be clear, because the thing is that what this is where the debate we were having. So, like, in the end, if we're looking for the basis point, every 1 basis point to be equal to the same dollar amount, and therefore a 10 basis point move in a 2-year is equal to a 10 basis point move in a 10-year, you have to be 3 times leveraged the 2 years over the 10-year. So this is where the volatility in something like the TLT versus the IEF is so different, is because
that's right. So Patrick, 1 second, it's actually worse than that because the 2-year is $200,000 notional.
Right.
So when you're looking at that, it's actually even more leverage than that.
Right.
It's almost like, what is that, 7?
Yeah.
7 to 1 or
6,
a little
7,
less.
1. Yeah.
Yeah, something like that.
Well, lucky we don't have to do math for a living, right?
That's right. It's okay. We're equity traders mostly. But one of the things that when you look at this, you realize that there's different ways to play different parts of the curve, because right now we've got a situation where the market is running ahead of the Fed. But let's say we got a situation where the Fed ran ahead of the market. You could get a scenario where the long bond actually sells off even though the Fed is lowering rates. Because if you think about what is a bond investor's worst nightmare, it's inflation. And so there's often times that different parts of the curve do different things depending on whether the Fed is easy or is hawkish.
Right.
And understanding how to play these different parts of the curve and how to go about trading a bull steepener, a bear steepener, or even just putting on the steepener in general with no overall view is important.
Yeah.
I have long said that I think that the ultimate trade will be to own steepeners outright, because the Fed will accommodate an increase in inflation and long-term bond investors will pitch it. And we've talked about this in the past. I always went and said that the 530 is the best place to play. I was a mope. I had that on I bought that and then I got rid of it because I thought that the Fed wasn't going to follow.
Well, listen, you've been on this trade for a while though, dude. Like, so
that's
you,
right, but I got off of it.
Like but you only pulled it off. Like, come on, you only lost 10 basis points from where you pulled it off. Well, you pulled it off in the 60s, right?
Yeah, so that was where I kind of said I think.
Yeah, whatever. You can still get back in. I mean, the point is you were long the steepener for most of this move. So kudos to you, dude. Like, that's been a great trade up until then. You just chickened out a little early.
Just chickened out. But I really think that owning steepeners is going to be ultimately the best trade of this next cycle.
Yes.
I believe that this is the kind of trade that you want to own, because I think that the Fed is going to accommodate and allow the economy to run hotter. And if that is the case, the last thing you want to do is own long-dated treasuries. And I think that what you'll find
I'm
is
in
that the
disagreement
Fed
with you,
will,
but anyway, like you can listen. I just, but
that's
just
what makes a
that's
market.
what makes
That's
a
what makes a
market.
market.
But just to
And
show people the thing, like back in 2008 through 2010, when the steepener on the 530s started to kick in, it went from 0 to 3. Like that's big money.
right. And that is a lot safer trade than just trading bonds outright.
Well,
And
it depends
I
on
really think,
leverage, right? It all depends on what the
yeah.
magnitude you take. But I mean,
Well,
you're
anyways,
right. No,
yeah.
no, but you're right. But playing the steepeners has a lot more of a hedge than taking an outright bond position. There's no doubt. Like, I'm not going to disagree.
So, so I worry about those who think that the bond rally will continue and are owning long
So
dated
you're worried about me. You're
bonds.
worried about me.
I am, because I
I'm
think
glad you
that if
care. You know what?
yeah,
I
I think that if the Fed is as easy as I heard Raoul Paul talking about 250s, two cuts of 50. Druck is talking about the fact that we could get zero ZERP again in the next year and a half. If we get a situation where that is the case, and then imagine you combine it with Stevie's increased inflation worries,
Yeah.
where the Fed is monetizing what we might view as increased inflation going forward. You could have a situation where the short end is actually a great buy in terms of owning twos, but the long end gets destroyed. So you need to be aware of the different parts of the yield curve, and you need to think about the fact that it might not all move as well as you think it does. And you also have to be aware there's different ways to play it. Now, I always laugh, Alex Gurovich is his idea of trading the yield curve is deciding on where he's long.
he's my kind of guy. He's my kind of guy.
Yeah, he's just well, I think the yield curve is going to steepen, so therefore I own extra twos. Or if he thinks the yield curve is going to flat.
To each their own. There's different ways of making money in the market.
I love Alex. He's a great guy. And you know what? We have to have him on one of these times. You two can have your kind of
a bond kumbaya,
little kumbaya bond trades and stuff. But I do agree that you should be aware of that, because if you went and this past week owned a leveraged version of twos, as opposed to just a straight outright tens, you were much better off. If you own the equivalent, the risk equivalent of twos, you were much better.
Because a lot of our listeners are just investors, and so they're thinking they're going in and either they're going to buy 2-year treasuries or they're going to buy 10-year. When you're buying the equal dollar amount, let's say you're just an investor, you got a million in your account and you're going to buy bonds, and if you buy the equivalent, the 10 years can have done much better. But if you're doing a risk adjusted sizing, the 2 years did much better.
Well, and the other thing I would argue is if the Fed is ever as easy as you bond people want them to be, or you at bears want them to be, let's just say that, I would argue that you could see a situation where they cut rates and the long end sells off. And I know that's crazy. I know
it is crazy, but it's okay. This show's all about crazy.
I saw Druck the other day. He was talking about the fact that during QE, the long end of the curve declined in price, went up in yield. And he said everyone argues with him, but when you go look at the stats, this is what's happened. I completely agree with him. I'm going to put the chart in the actual market roundup that we send out. But if you go look, during QEs, the long end sold off.
Okay,
so the worst thing you guys could want is the Fed to do more QE.
Okay, but so then let me ask you something. What's your over under on QE in 2019? Very low, right? I would imagine very low.
No, but QT I think is being bond positive.
Okay, but no. I asked you a question, because the thing is, to me, I think you're right. The timing, though, I think that there's still room throughout 2019 and maybe a part of 2020, a chunk of it, where your scenario is just not going to happen. Inevitably by 2020, late 2020, 2021, when at some point some form of QE is up and running, then I could start buying
But
your
listen,
argument.
Patrick, they're still doing QT, bud.
Okay.
So like, so you're asking me the odds of them stopping QT?
Well,
I would
September
say
they said they're going
very
to
high.
unwind. Okay, they're unwinding QT.
Yeah. So
but that's not QE.
yeah. Okay. So, but I think the fact that they're stopping is the first step, and it might actually, you might find that although you would think that is bond positive, it might be more bond negative, because on the whole,
they didn't start QE until we were deep in a recession and shit was hitting the fan, and they had to dump liquidity back into the market, and they fired up the printing presses and ran it hard. And we are that in that scenario, you are dead right, but we are a while away from that, maybe even a year or more away from that. And therefore, I think you're right in the long term, but I think you're way too early.
Okay. Well, it doesn't matter. This is a great tool for all investors to have. People think they ask me, you must be been a bond trader in your previous life. No, I was an equity index trader. Bond is just math. It's not that hard. I'm going to include in the market roundup both the 210s and also the 530s hedging ratios. But there's also, I want to say one last thing. Even on on IB Interactive Brokers and Trading Technologies, these spreads of like 2s versus 10s, they have an actual contract that trades, meaning that you can go and trade that.
I didn't even know that
as a contract.
That's awesome.
Yeah. So if you put in ZT onto your Interactive Brokers, and then you go to the bottom where like hide or show more, there's a section where you go show more contracts, you'll see that they actually have all the different spreads.
That's awesome.
And it's actually, this spread that we're talking about is the TUX spread, TUX, and you'll see that you can trade it as an outright contract.
That's awesome. You know what? You just taught me something, because that's awesome.
Yeah.
I didn't know that.
And it's not that hard. I know there's a lot of people out there that are very familiar with option trading. They're very familiar with equity trading, and they're kind of hesitant to get into bond trading. It's not that hard. It's all math. And when someone says trade the Steepener, it's not that complicated. You can go do it, and you can do it. There's a contract on the CBOT or the CME that actually allows you to do it. Take advantage of it if you're a futures trader, because it's something that I think that we'll see more and more as we get more volatility in the fixed interest rate environment. Our fixed income environment, you're going to see that this steepening and flattening in different parts of the curve, the shifting will be huge, and this is a great tool to have in your arsenal.
Kev, I'm just going to leave you with this, and just for our listeners to know, because I want to know your opinion. Do you believe, even if it may not be the real breakout right now or not, are we going to go through a steepening cycle on the 210s? Because this thing is obviously everyone's waiting for this thing to invert. And are you still in it's going for inversion camp, or do you think that this could be the beginning of the steepening on this, and this is a bottom on this?
Hi, Patrick. That is such a tough question, and I'll tell you why I'm struggling with it. I'm struggling with it because I do not believe that the Fed is going to follow the market down as quickly as everybody believes. The short end of the curve has gotten way ahead of itself, and I am reluctant to join the crowd that believes that they are going to cut as quickly as they think. Having said that, at the same time, I believe that there's more inflation coming, and we are going to get a situation where the market will be surprised about inflation.
Yeah.
So I guess if you made me decide, I would say on the 210s, I'm unsure. 510s or 530s, I definitely think we're headed higher, and we're going to be surprised. I still hold to my prediction that before this cycle is through, before this next inflationary environment is through, we were going to see all-time wides in the yield curve. And that is something I believe. And
what?
The only thing that
all-time wides,
yeah,
all-time
wides. Everyone is sitting around trying to buy, VIX vol, or trying to predict the end of the world in terms of equity collapse or credit collapse, just like 2007-8. I contend that the last crisis, the next crisis never looks like the last crisis, and that it's always something that nobody is expecting. And if there's anything that nobody is expecting, it's inflation. I think it's going to come. It's going to rear its ugly head. And I still think that that's the real danger in this market. It's not another 2008. I'm more worried about a 1979.
All right, so I'm going to make my prediction. You want to know what my prediction is?
Sure. Yeah,
okay.
Sure. We're going to zero.
No, my prediction is that this is the next Widowmaker trade, and your wife's about to be a widow.
I like it. Hey, you know what? I want to talk about my wife for one quick second. I know she doesn't listen to this, so it's no problem. But we were playing a game. We played this game called Quirkle, and it's a terrific kind of board game. And the other night that she said to me, "Oh, you want to play? I'm going to kick your ass like usual." And she's a very good Quirkle player, I must say. I'm not smart enough to compete against her. But I said, with talk like that, the market gods are going to punish you. And she says, I don't believe in your gods. I don't worship the same gods as you. And I said, well, so be it. And guess what? She got crushed. And she's like, "Oh, you just got lucky." I go, "No, the market gods punished you for that kind of cheap talk."
That's what. But I'll tell you, you know what? I do not know. I have a lot of emotions about that intro slide that you have of pictures of me, because I think that you are taunting the market gods on my behalf, and I don't know whether that counts. In their eyes, because I'm trying very hard to be humble.
Patrick, don't lie. You told me to do that. You made up that slide.
Give me a break. You did that slide. I know I'm that buff, but you made the slide.
No. It's just the funny part is how you're telling me how you're working out just like him, and you look just like the second slide.
Oh,
that's what.
Oh yeah, whatever.
Okay, listen, we've gone off topic. Let's go to the next thing. Let's call it a day.
All right,
here.
So let's go to Tales from the Trading Desk, and you got a good one for us. So what's on your mind here, Kev?
Yeah, well, it is a good one. We're gonna play a video because this whole Tales from the Trading Desk kind of came to be because I saw Barry Ritholtz, a really good guy. I like him. I enjoy his stuff. And he interviewed recently Professor Scott Galloway, who has written a book lately about happiness. And I thought it was one of the best podcasts I've listened to in a long time, even better than the Huddle. And he was talking recently, and they were talking about buying a Gulfstream. Anyways, let's just play the video because, there we go.
But there's my favorite line in this. In the whole book, my favorite line in the whole book.
Yeah.
In 1999, I and a gaggle of other San Francisco internet founders and CEOs went to an airfield where we browsed private jets. It made sense to me that at 34, I should have a one-bedroom apartment to transport me across the surface of the atmosphere at Mach 0.8 because I was a fucking genius who could afford on paper to spend the equivalent of 1,000 years of my mother's salary on a Gulfstream. That sentence is a piece of art.
Thanks,
I love
Ross.
that sentence. But talk to me about what that canary in the coal mine was in 1999 when you were kicking the tires of Gulfstreams at age 34.
And so just to cut to the chase, within a year, the market returned to sanity, and I achieved Mosaic status on JetBlue, but I never got the Gulfstream.
Right.
Look, even at that time, I realized that this was a trope, and this was abnormal, and that we were about to get slapped pretty hard by the palm of the market, and we were, and it was coming sooner than we thought. But look, it all comes down to this. I think when you don't do well, so in the same story I talked in 2008, when my oldest son had the poor judgment to come rotating out of my girlfriend, I called my accountant, and he told me I was broke.
Oh, really?
So I was 40. And broke, and I thought I had a successful career just about the time that someone else was depending on me, my child and my girlfriend. And that was hugely emasculating for me, really did a number on my head.
Really?
Oh my gosh, it was awful.
Wow.
Okay, so
that's awesome.
So it's pretty funny that he was gonna, he goes from buying a Gulfstream to not. Oh, there we go, going to the next ladies' beer.
Oh no, I ran
anyways,
out. I'm on this shock top Belgian white.
I know. I'm the same way. I ran out too. These sponsors have to send us more.
That's for sure.
So the funny thing is, I saw this video of him talking about buying a Gulfstream, and it reminded me of a story. And I'm not going to name names, but there was a hedge fund manager that we dealt with in Canada, and he had a big position in a Canadian mining stock. It's one of these junior gold crappy things, and it was a big position. And this guy was this hedge fund manager was a wealthy fellow, and he owned a lot of the fund, and he owned a lot of this company. He wasn't kind of that extra digit like billionaire, but he was in the hundreds of millions. And when he started talking about the fact that when this company got taken out, he was going to buy himself a Gulfstream, a G5, I was like, oh my God! If there's ever been a sign that this is gonna that you should be shorting the stock, here it is. Because when people start deciding what they're gonna buy before they've even sold it, and when it's a Gulfstream, like that you should be shorting.
Oh my
the stock.
God! You know what? I'm gonna. That's it. Next week I've got a tale because that exactly happened to me. It wasn't a Gulfstream that I was thinking of buying, but it was my early training.
Come on, Patrick! It was a Gulfstream.
No. I was not a high roller back then. But you know what? There's one danger in this market is counting your profits before you've turned them into before you sold, before you've even seen up
for
there,
sure.
Right? And that's the most dangerous thing.
Yeah. And it's funny how it'll happen to people that are deciding they're going to buy a new BMW and those that are going to buy a new G5. It's all the same. The market gods do not care. They do not discriminate.
There's a great story of that in you know what? I'm going to dig it up for next week. But in the reminiscence of a stock operator when they were talking about in the brokerage they're going to buy a fur coat. Do you remember that part in the book?
No.
I'm going to dig it up.
No.
But
not a real fur coat because that's cruel.
But great story though.
Only Canadians will get that joke. But anyway, so be it. Just the lesson here is never count your G5s until they're sold.
All right.
Okay,
let's move on. So we're gonna get to this week in trading history, and I got a good one for you.
Oh, this is where you excel, Patrick. This is it.
Yeah, I agree, and I dug up. I agree. I'm good at this now, but third beer in. All right, so John Maynard Keynes. He was born on June 5th in 1883 in Cambridgeshire, England. And obviously, this guy he's a legend, right? And so he's a legend. Obviously, the first thing that always comes to mind when you think Keynes is his famous book, The General Theory of Employment, Interest, and Money. Right? Yeah,
that's right. That's what everybody thinks about, Patrick. That's the first thing that. Well,
I mean, that's his most famous book, is it not? And
yes.
Anyway, so he is the father of modern economics. I mean, his entire school of economics named after him, right? And correct me if I'm wrong in describing Keynesian economics, but it's generally, actually, I'm going to just read it. It says generally argue that the aggregate demand is volatile and unstable, and the market economy often experiences inefficient macroeconomic outcomes in the form of economic recessions when there's demand is low and inflation, which is demand is high, and that these can be mitigated by economic policies, right? And so this idea that monetary policy actions by central banks and fiscal policies, one of your favorites, and the actions by the governments, which can stabilize the output over the business cycle. And Keynesian economics generally advocate a managed market economy. Right, which is this idea that the government steps in when there's a recession, spends when the demand is low, and subsequently cuts back when there's a healthy economy. That's a fair way of sizing it up? Is there something you'd want to add to that?
You got it
right.
And one of the things I'll just kind of highlight is the fact that Milton Friedman said during the Nixon administration, he said we're all Keynesians now.
Well.
And that was because, and I think I think a lot of people believe that his policies have been perverted.
Yeah.
And we'll see, we'll go into
Well,
that
I
a
mean,
little
they're
bit,
perverted because our financial system is a little bit perverted, right? I mean, it's just a function of but it's a function of where we are in this cycle, right? Like, I mean, with such a massive debt overhang in the whole system, it can't run the way I think. Like, I think if Keynes was alive today and he tried to interpret what was happening in the financial markets, I think he would draw himself different conclusions than his general theory.
Well, I think that don't forget he would have thought that you paid down the deficit debt during.
But again, that was in that
which basically never happened.
Yeah, but okay, all right, and so.
Okay. Anyways, keep going. Sorry, I don't mean to interrupt your history
this is
lesson.
Good. This is good. I like it. The point is, he came up with the general theory. There's an entire school of Keynesian economics. But I wanted to highlight a few more things in his life, right? So we're talking about the man, not the theory, right? Where we're talking, he was born in This Week in History, and we want to sort of talk about what he did. And so one of the interesting things was he wrote a piece called "The Economic Consequences of the Peace." And I know Grant Williams kind of took that theme and he did a little video on gold and stuff like that on that theory. But when he wrote this, it was really about the Treaty of Versailles, right? And so after World War I and Germany having surrendered period, then the French, English, Americans got together and they put together this treaty. And Keynes argued against the Treaty of Versailles. He argued for much more generous peace. The French wanted things to, the Germans to pay heavily for having caused this war. And the reparations were very tough. And Keynes took an approach that's saying that's not, we have to be more generous about the peace. And that for stability around the world, that the Treaty of Versailles generally was overkill. And in many ways, the Treaty of Versailles could be blamed for hyperinflation in Germany, the rise of the Nazi Party, and arguably was a massive contributor into ultimately the beginning of World War II. Right, and so he was a skeptic right from the beginning. And if people listened to Keynes back then, maybe World War II may not have happened. I don't know. It's a speculation. I mean, I'm only time traveling now, but it is interesting. But that's not the most interesting part about Keynes for me. You want to know what it is?
What is it, Patrick? Tell us.
To me, it was his role in Bretton Woods. So, everyone here, especially when you're in the gold bug circuit, and I don't mean gold bug being derogatory, but like when, there's the other beer. Oh, there you go. What is that, number 4 for you?
No, so I don't know, but you don't mean to be gold bug being derogatory, but yet you do.
No, I don't. I'm a closet gold bug, so I'm not going to shit on my own kind. But anyway, the point is that Bretton Woods, he was instrumental in its origins, right? So the Bretton Woods Conference that occurred was the birth of our modern monetary system. It happened in 1944. To think about it, Bretton Woods was going on when Hitler was still alive, right? The atom bomb wasn't dropped yet. But at the time, the Allies had a pretty good idea that they were going to win. Right? Like everyone knew that it was just a matter of time before Germany and Japan fell. And so they were already getting together to talk about what the New World Order was called. And the New World Order seems like it's scary, but they literally called it the New World Order back then. Like what is it going to literally look like in the post-World War II period? And Keynes played an incredibly important part in what is today, what back then was installing of the U.S. dollar as the world reserve currency. right? To be held by all central banks, collateralized against gold reserves. Like all of this originated from Bretton Woods, and Keynes was there, and it was his brainchild behind a lot of this, in terms of what where we are even today. And so everything from the dollar being the world reserve currency, there's a great book summarizing this. The book's called The Battle of Bretton Woods. It's a must read.
Right. So, Patrick, well, I got to stop you here. You call something a must read, but we all know you can't read.
All right, so it's a must. You have to download the audiobook and must listen to this audiobook.
It's a must listen.
It's a must listen. Well, thanks for shitting on me. All right, I appreciate it.
That's right. When we go look at Harry, by the way, you know what? Although Keynes was instrumental, do you know who he was up against?
No, I'm getting to that. I'm going to talk about White.
I'm sorry, I didn't mean.
We're going to talk about Harry Dexter White and Morgenthau and all of these guys right now. So back then, it was, while they tried to make it paint it as an international conference and all countries were welcome. Let's call a spade a spade. It was an Anglo-American consortium of basically the former British Empire negotiating with the new up and coming world superpower of America, where the vast majority of the world's global gold reserves were being held, and it was about them negotiating the post-war financial system, global financial economic system, right? And so Keynes, being British, obviously was going there negotiating on behalf of a hollowed and bankrupt British Empire against this new global superpower America, where, I mean, I don't know whether I'm pulling stats out of my ass, but I think like 85% of the world's gold was on U.S. soil at the time, they were the one that were supplying the world with all of the goods through the war, and they've become this huge power. And so they're planning out this new world order, right? And so Keynes and company in England are going up against Harry Morgenthau, which was the Secretary of the Treasury, and his senior U.S. Treasury Department official, Harry Dexter White, the one you were just referencing. Right. And so Keynes, though, was the brainchild behind a lot of this. He was the one who came up with and pushed for the creation of the IMF, International Monetary Fund, that's around today, the creation of the World Bank, which is around today. Yep. And at the time, he was pushing for the creation of the Bancor, which was to be world money for the settlement of international trade. Right. And so the idea of making world money, and whether we look at SDRs today and other things like this as world money, the idea was that there was going to be this Bancor that was going to exist. But he also had an agenda to protect British imperial interests, right? Because prior to all of this, the British Empire, I think, controlled 25% of the land mass of the world, right? And they had preferential trade agreements with all of the Commonwealth, and they were trying to protect those interests. And of course, the Americans wanted that completely to be dismantled, because there's no benefit to them for the British having that imperial interest. So Keynes was coming in there with all of these ideas. But what's amazing was the deception that occurred at Bretton Woods. So the conniving Harry Dexter White, if I may call him that.
You're going to get us in trouble from all the Americans, and although the British
listen, this is all documented from after 50 years.
Conniving,
maybe that's a strong word, but anyway, the point is that Harry Dexter White intentionally asked Keynes to take charge of the part of the conference that was in charge of structuring the World Bank. So that way he gets him out of the negotiation where the Americans were trying to sort out how to make the U.S. dollar the world reserve currency.
Crazy like a fox, that Harry.
Crazy like a fox. And in the end, they deceived Keynes. Keynes so Harry Dexter White negotiated out that basically the gold was the world reserve currency. Gold was the core to it, but it would be U.S. dollars that were backed by gold, and the rest of the world would use US dollars as the reserve currency, which was backed by gold. So he added that extra step where all the global central banks of the world would own US dollars, which were backed by gold, which in their mind was the equivalent of gold.
Right.
Except in 1970, when you pull the gold as the backing of the dollar, suddenly you have the US dollar as the world reserve currency. Anyway, you get into Triffin and stuff and all that other funky stuff that happens with all, you know, what we talk about on all our podcasts all the time as to the consequences of the dollar being the world reserve currency. But that all originated there. But more importantly, it was Harry Dexter White that deceived Keynes, because Keynes didn't find out that that was the language put in until like a week after the conference ended. He would have never agreed to it, or he would have made a huge ruckus if he found out. And in the end, because they put him in charge of something else, they completely pulled a fast one on him. And in the end, that's how the U.S. dollar became the world reserve currency. But anyway, it is about Keynes this week in trading history. Hold on, but and
wait, before you wrap up here, there he is. Yeah. I have my little Keynes that I want to share with you, because I've been researching them as well. I'm not quite as knowledgeable about the specifics about the Bretton Woods as you are, but I did want to kind of highlight that Keynes was really actually, although he was from the early 1900s, he was more geared towards the current environment in terms of being advanced on social matters than you would have ever guessed.
He's an MMT guy before he even knew it.
No, he's not an MMT guy. But listen, he would have been at the head of the Me Too movement, because listen to this. Keynes was a pioneer of women's rights to control their own bodies and gender equality.
Okay.
The restricted availability of contraceptives, the lack of sex education, marriage and divorce laws that treated women as subordinates, criminal sanctions against homosexuality, job discrimination against women, unequal pay. In all these matters, he said, the existing state of law and orthodoxy is still medieval, altogether out of touch with civilized opinion and civilized practices.
He's a smart man.
Yeah. And here's something also you didn't know. Did you know he was bisexual?
No.
There you go. These are the kind of things you find out on the Market Huddle that you don't find anywhere else. That's not on CNBC.
You can't find that on Wikipedia at all.
Well, I don't know on Wikipedia, but you know. And as Lena told me the other day, who isn't bisexual these days? That's what that's what Lena, our audio engineer, told me. So anyways, so he was much more suited towards today's environment than he was than the early 1900s.
Well, there you go. Anyway,
we'll leave it there.
Keynes was born in 1883, and he reshaped the world that we know today. And well, that's this week in trading history. So let's move on. Kev, it's time for what's becoming a fan favorite for sure, is the WTF clip of the week. And what do you have in store for us?
Well, I have a very distinguished professor from Harvard, Ken Rogoff. And I decided to meld in his interview with a little bit of old school. So let's just play the clip.
On the other hand, if the extent their monetary policy is easier, it pushes up the dollar. And that's not so horrible for us, but it's not good. I mean, I think the Fed right now is in a position where they would much rather see inflation.
What kind of gun is this? That's a tranquilizer gun. If any of these little fuckers decide to freak out on the kids, I get to take them down.
I mean, I think the Fed right now is in a position where they would much rather see inflation overshoot 2%.
Hey, be careful with that. That's the most powerful tranq gun on the market. Huh, got her in Mexico. Cool. Yeah, it is cool. They say it can puncture the skin of a rhino from 100... Ow! Oh! Yes! That's awesome!
I mean, I think the Fed right now is in a position where they would much rather see inflation overshoot 2% for a sustained period than have a recession. If inflation overshoots, it just builds their credibility that.
What? You just took one in the jugular, man. Ha. Whoa.
Yes! You should pull that out. That shit is not cool. Wait. Pull what out? The dart, man. Got a fucking dart in your neck. You're crazy, man. You're crazy. I like you. But you're crazy.
You're crazy,
man.
man. You're crazy.
Crazy. That's such a good movie. Old school. Like, it's so good. Like, I just love it. Like, it's like the moment it touches your lips, like Will Ferrell. I think it's Will Ferrell.
It was him at his best
movie.
Yeah, it was.
Yeah. And Vince Vaughn, like, it's so good. But what's even crazier is Ken Rogoff talking about inflation. He'd much rather see inflation overshoot. This idea that that we're going to... It's kind of shocking to me how willing they are to accept that. And I love, do you follow Rudy Havenstein on Twitter?
Yes.
And he's obviously the 184-year-old German banker that was in charge during the great inflation of the Weimar Republic. Yeah. It's amazing that he's lasted this long, and it's even more amazing that he's managed to pick up an account on Twitter and be so witty. But he's the one that's kind of often just laughing about the fact that these central bankers want inflation so bad and they can't even do it, yet it is happening all around us. Anyway, it doesn't matter. It's kind of funny, and it was strange to hear Rogoff talking about it out loud so kind of blatantly, talking about inflation overshooting, and I just thought to myself, I like you, but you're crazy, was the perfect kind of melding of that clip.
Well, that was crazy. So I thought it was really good. All right. Anyway, let's move on. Kev, top 5 things to watch next week. But before we do, we have to review last week. And so let's jump right into it. And let's start off by talking about those U.S. and Italian manufacturing PMIs. And what was interesting about this was I thought it kind of went in two opposite directions, right? Well, because you sort of had a scenario where Italian PMIs were bad, but they were still under 50, but they weren't as bad as everyone was making them out to be. And at the same time, the U.S. ones have weakening faster than everyone.
Yeah. The U.S. economy is slowing quicker than even like all us bulls believed. You bears obviously knew this was going to happen.
And so here, I'm just using Forex Factory. I have the chart, but this using something like from Julian Brigden, or I think it's or even the Hedge Eye guys do the same. Which is, it's not about the number; it's about the rate of change and the direction of the trend, right? And when you just look at this graph, like we clearly peaked in middle of 2018. And we have had a trend of ISM manufacturing PMIs in the U.S. weakening, and it looks like it's heading to zero. Yeah, I mean, so not to zero, to 50. To 50. Sorry, my bad.
Okay. I know you're bearish, but I thought that was a little extreme for even
heading to zero. It's definitely no, but it.
That's what Keith believes.
Oh, anyway. We're not bringing Keith into this, but the point being is that the numbers continue to weaken in the U.S. Italy's still under 50, which is recessionary, but it wasn't as bad as everyone thought it was. But you know what? It is what it is. I think that nothing has changed. The trends of the U.S. economy weakening is still very much in play. All right.
Okay, let's go on to number 4, grains and coffee.
Which have pulled back, but I think it's a buy and dip.
You do?
I think so.
You're a big grain bull, are you?
You know what? When these types of trends begin, it always shocks everyone. including the guys at optionsellers.com, how far these things go.
And listen, grain goddess of grain. She's a big buyer of corn. She nailed it. She got the right one. I must say I'm long corn. I think we're headed higher. And
shit, you and me agree.
I hope I didn't go.
Shit.
Yeah, we goochered it. You better sell it. Everyone sell it.
No, we're not allowed to. No,
Anyways,
no.
Are you
know
long?
what?
Are you actually long corn?
Are
you actually long corn?
No, I'm buying the dip though. But which was so the moment I buy, if we're both long, then this is really bad for.
Yeah, that's okay. So it's never going to go there. It's going to be fine. We're going to rock it higher. Anyways, be careful, everyone. Mark, both Patrick and I agree. So there's a good chance we head lower. Number 3, Deutsche Bank.
All right.
It's like death by 1,000 cuts.
Unbelievable.
It's so ugly.
Okay, so I'm looking at it here, DBK, and so this is the euro price, right? Under €6.
So I saw the greatest tweet by Tracy Alloway from Bloomberg News, and she said, "To all my friends at Deutsche Bank that were working for a not-for-profit sector." And I thought that was the funniest line. I thought, "Oh, Tracy, you're funny. You're like, you know what? I would love to have Tracy on because she just seems like the kind of person that would laugh and have a beer with. She seems like a huddler. That's all I can say.
She does.
Not a cuddler, a huddler. Anyways, I see Deutsche Bank, and it's
unbelievable. It's unbelievable.
Everyone's giving me a hard time about Deutsche Bank.
Look, you made a bad call at 10. But you've admitted you're wrong, and you walked away. There's no one that I'm not going to shit on you on this more. You admitted you were wrong, and you're out. So there's no point in a thing that you're out. But it's crazy. Like I mean, does this go under 5? This is now like. Let me go to the U.S. one. So
I don't know. I don't know if it goes under wherever, but I do know that the longer. Listen, I actually want to talk about this a little bit. Italy recently got chastised by the EU again about running a large deficit. And we're going through the same shit. They think that they're going to solve their problem with ever-increasing extraordinary monetary stimulus while doing fiscal austerity. Right. And if they continue to do that crap, we are headed lower on Deutsche Bank. We are headed lower on the whole European economy. Eventually, we're headed lower on the euro.
Yeah.
It's just stupidity and asinine to the greatest degree. Pull up the Bund, because the Bund
you want just a yield. Let me pull up.
Yeah. I think.
Here.
I think it's what's driven this whole
here's the
move
actual Bund. So this is the 10-year.
Okay, it doesn't matter.
Look at that.
It's gone. Parabolic,
you know what? This ended.
Stupid.
Okay. PIMCO back then. PIMCO's Bill Gross. Obviously, he left PIMCO.
He went to Janus.
But this ended his career.
Yeah.
It ended his career. He entered what in your Steepener trade. He entered the Widowmaker, and this is where I think all of you inflationists have to be careful. Because in the end, it will always be shocking how low interest rates can go, and no matter how much you see inflation everywhere around you, like right out of 6 cents or whatever you're talking about, the fact is that you will be shocked at how low these bonds will go. No, sorry, bonds will go high, but yields will go.
Excuse me, I just threw up in my mouth a little bit from
all right. Well, then let's move on. ECB, because what did Mario Draghi see? Number 2.
I don't know. That guy should just pack it in. Like he's gone. Well, listen, it is impossible for him to do anything. I don't care what he said because
everyone's turning Japanese.
But I don't care. I don't care what he said.
And no different than you care about what the Bank of Japan says, because this is the destiny of all of these in the existing monetary system. Listen, if MMT comes around or something, we'll have to redraw the chart book. But I'll tell you that the ECB has turned Japanese, and it's only a matter of time for the U.S.
You know, when you said my destiny, all I can think about is Marty McFly Sr. I am your destiny. That's what you remind me of. You're about as cool as him, too. Okay, let's
the
go
jobs
on.
numbers. Bad print, on the jobs.
Oh my God, it's terrible.
And therefore, the market needs to
listen,
rally. But this is the great irony is that the bulls now need the numbers to be shit, because the more shit they are, the higher they can take the stock market.
Okay, so listen, I think this is actually more complicated, and I had a discussion with one of my friends this morning about this. I think that the reason the stock market is going higher is because bad economic numbers makes Trump more willing to come up with a negotiated settlement with both Mexico, and I'm scared to say this, loath to say this, because I'm going to get a whole bunch of stuff.
Don't say it. Don't
China.
say it. You just said it.
I'm going to say it. I know.
No, you're wrong.
I don't know. Listen. I understand the argument that China's going to get worse. I get it all.
You're la la land.
At the margin,
you're la la land.
No, I don't care what you're going to tell me should happen. Fine, you tell me what should happen. I don't care. But I'm telling you what the market is anticipating. And the market is saying that he's more likely to bend.
Yeah, you're the one who liked David Rosenberg's little comment on how he thinks the whole thing's going to flip, right? Like,
no, what did he say? What did David say?
No, just the fact that they were going to let the market more or less weaken to force the Fed to give interest rate cuts, and then going into the election, he was going to come up with a China deal to skyrocket the stock market, and he gets the best of both worlds of lower interest rates and higher stocks going right into the election.
I think David's giving Trump way too much credit for being smart.
But they're calling him.
I don't buy that, but I do.
Anyway, go on.
Sorry, go ahead, Patrick.
No. I have nothing else to say. That's what David Rosenberg said.
But I do believe that this increases the chance that they come to a deal. And regardless, let's face it, all financial assets are priced off of the long-term interest rate. And the fact is that long-term interest rates have declined whatever this ungodly amount is on this rally on bonds. And you have to mark it provides a floor for assets. And in some case, I contend we're going to get new highs. I actually feel more confident about new highs today than I did a week ago.
All right.
And it's all because of the increase in
I
the bond
dare
price.
not say a word to taunt the market gods. Good for you. You know what? You can stay long. I'm not going to say another word.
Okay, so Patrick, when there's new highs, okay, listen, I'll tell you this. Patrick, do you think there's going to be new highs this year? Okay, burger bet, we're done.
You know what? You are writing checks your wallet can't cash, dude. You know how many burgers how many burger fucking bets you've made.
Okay,
I've got a lifetime supply of burgers from you. I can't.
Okay, that's all I need to get. Stop talking. Burger bet. It's fine. Let's go on.
But by the way, our listeners need to know that we have a bet on the 10-year Treasury yield that came very close. But it's not a burger; it's a steak dinner, and I'm freaking going full wagyu on your ass on this one. We were doing the over/under on a 2% yield by the end of the year, right? Now it's still obviously halfway through the year, but it's toying with 2%.
Okay, so do you know what? I just want to tell everybody what you said.
Tell me what I said.
And you said that there is no way I'm not going to lose this bet. You said that a minute.
No, I'm not going to say anything else.
No, yeah, because I was right. And so for those,
I'm sorry, I am 5 basis points away, Kev.
Yeah, but listen, those bond bulls out there, if this doesn't work, you only have one person to blame. It's Patrick. That's all I'm saying. Only one person. He tempted the market gods.
I'm
You
going
pissed them off.
wagyu on your candy ass on this one, buddy.
Yeah. Okay, there we go. Okay. Okay, let's go to the next thing.
All right,
here.
let's go to the top 5 things to watch next week. All right, and we've already, by the way, have way too many bets going, so we're gonna have to calm this down here because I don't know, Lena, are you writing these things down, Lena? I'm gonna lose track of all these bets.
Poor Lena's getting it.
You
know what, Lena, you're in. When I lose the next one, which Patrick is sure I'm going to lose, I'll buy you burgers too.
All right, good stuff. Lena, you got to write these
let's
down.
go.
All right, top 5 things to watch. So, Kev, what's at number 5?
U.S. retail sales.
Right.
I don't know, Patrick. It's bad. Like I don't want to start getting bullish on the economy because the reality is that this Trump Mexico tariff thing has been he's gone and put like sand in the gears of the economy, and I'm not going to sit there and tell you that everything's great until he figures it out. I think he's actually been one of the stupidest things I've ever seen.
What?
Why? And he won.
I was just going to say how I'm shocked how volatile this number has been. We saw basically like almost from a decade perspective, a decade low print and a decade print high print in the last 4 or 5 months. Like just in terms of the size and the magnitude of these. So there's no consistency in this trend. So you have to pick up on a much bigger picture trend here than these monthly prints. But the question is that do they come in negative? Everyone's expecting 0.7. That looks like that's the consensus here on this. And so the question is that do we hit 0.7?
No, you just said negative.
No, 0.7.
Your whisper number is way lower. Let's face it.
No.
It is. And the whisper number is on the
we
whole.
We were minus 0.2 last month, but the whisper number is positive. I'm not a fundamentals guy. I have no insight on this. I'm not going to say anything else. I think though that the economy is going to weaken throughout the remainder of the year. So month over month over month over month, I think the numbers will remain weak. As to what this month comes out, we'll see.
Okay. Let's
so
see.
Number 4, I wanted to talk about the two, in my mind, the two biggest darlings when it comes to the largest holdings in funds. Now, there are other stocks that are also incredibly widely held. So I'm not trying to say it's only these two, but when you go to look at the top fund holdings, especially on discretionarily managed funds, routinely one of the top 10 holdings that appears over and over again is Visa and MasterCard, the two companies, and they have been just amazing on their performance.
So I'm going to interrupt you, Patrick, because you brought this up earlier when we were prepping for the show, and I dialed the charts, and I hadn't been watching them, and I was just
okay, I'm going to put this on a weekly chart. I want to look at the 2009 to 2000. Visa went from in February 2009, it was trading at $11 to $170 today. I mean, you have to have owned an Amazon to have done better performance than owning Visa or MasterCard.
And you know what's amazing, Patrick, is this week. Let's just forget about the big long-term picture and let's just look at this week. These things have just run like they're stole something. It's shocking.
They continue to be a bastion of safety of the big money that kind of. I personally, I don't want to call it a conspiracy. I have a theory that these fund managers get together and they all pick their favorite stocks. And they generally are happy to support their favorite stocks and keep those prices higher to keep their performance looking half decent during these choppy periods. And I suspect that Visa and MasterCard fit the bill for these types of stocks that these fund managers continue to support very well.
Oh, my God.
Is it a bad theory? It's a bad theory.
It's a terrible theory, buddy. You've been reading Zero Hedge for way too long. Like, the idea that they get around and like what they have some secret meeting. Is that
No,
what they do
I
when
don't
they
say it's a
"Let's
secret
support-"
meeting, but there's a code. They just know.
There's a code. You're so full of it. Like it's not even funny. I'm gonna like have to go onto your computer and like zero out the Zero Hedge because like you're just been listening to that too long. The reality is that for whatever reason, these continue to rocket higher.
Well, okay, but they are
they-
in the top 10 holdings of a lot of funds. So can you dispute that there's a lot of funds that are focused on these stocks? And they're an important
No,
part.
I'm not going to dispute that at all. I suspect that there's a fundamental reason that they're doing so well. I don't know it. I don't know the story. I just don't believe that there's some cabal that's like causing it to go up. You know, like
Well,
that's the
I'm
most
a
ridiculous
conspiracy
shit I've ever
theorist,
heard,
and I
Patrick.
like my
I
story.
know, you know, you can put on your tinfoil hat or whatever. I do think it's interesting that these things have rocketed to new highs, even without the market
Unbelievable.
going to new highs.
Unbelievable. That's where the
And
leadership is.
the real question
if our listeners are momentum players and they want to keep chasing where all the money keeps going, you got to keep Visa and MasterCard on your radar because.
Yeah, I'm not saying you should buy it, but I think you should watch these things because I've been shocked at how well performing they are, and the fact that they broke out to new highs today, Friday. You know, what do you think that means about the market?
Well,
Patrick?
that just means to me, look, it's like the Nifty 50 thing. As at the tail end of a bull market, the breadth becomes narrower and narrower, and all the big money is chasing fewer and fewer stocks. And this happens to be right now some of the big leadership in the stock market. And I won't dispute that. These things can still go higher.
Okay.
I don't think my views on the S&P and my views on MasterCard and Visa are two very different things. Like, this is definitely where momentum bulls are chasing, and they're here and they're taking this higher. We'll see where they can take it.
Okay, well, there you go. You heard it from Patrick.
So let's move on to number 3. What's on your mind here, Kev?
U.S. inflation numbers. And of course, Patrick, you think they're going to underperform. We've heard from the good old Stevie Vicks, our friend. You know, I thought it was going to be hard to find someone more opinionated than Dave Cullum, but I think we found somebody. What do you think?
I mean, he's firm on his opinions. There's no doubt about this.
I like him. And he definitely thinks inflation is headed higher, and so we'll see. You know, we've yet to see the real inflation increase that a lot of us inflation bulls have touted. Yeah. So I'm not trying to say that, like, there's no way should we take any, you know, even remote semblance of a victory lap.
Here's the CPI.
It sucked.
And
yeah, listen, we've been wrong. Like,
but listen. Okay, I've heard a pretty good argument from both of you as to why inflation should be, at least in its trend, gravitating higher. But look, the forecast is actually for it to go down. They're talking 0.1 for the CPI print. They're talking 0.2 for core. And so right now, the market, at least on the whisper numbers and forecasts, continue to actually anticipate that inflation is going to be going lower. So if you and Stevie Vicks in any way are proven right, which I can't say is impossible. It's not probable, but it's not impossible. And if you are, the market's not pricing that in. That's big moves.
Yeah. The real problem is that we have no growth, and if we have inflation at the same time, it's going to be bad. It's a bad kind of combination.
Kind of stagflation.
I don't know if it comes this time. I still contend that the real problem in the next years to come will be inflation, not deflation, but that's what makes the market. Let's go on to number two.
I just had to ask the question, does gold have the momentum to break to 52-week new highs? And first of all, what a great run. Like, I mean, in 1 week, the thing tacks on like $50 an ounce in one go, right? Like, we went from just over a week ago, we were down at 1270, 1280, and we're now toying with 1350. Now, 1350 back in March and April of 2018, which is more than a year ago, we toyed with about 1360, and back in March, in late February, we tapped 1350. So we find ourselves again in this kind of 1350, 1370. Now, I'm a gold bull, and so are you. You know, you're going to try to play the devil's advocate or something here.
No, I'm not. I'm actually gold bull. No. Like, we're on the same page. So you guys should sell it.
It's dangerous because we both agree. But it hasn't broken out. Like, I like confirmation. No. I'm already long. I'm already long.
Patrick, how many tops do you see there, buddy?
How many? Look, let me put this on a weekly chart. I see like 7 or 8 major tops. Like, I'm sorry.
Well,
We've been up to this 1350 to 1400 range from 2014 till now. 5 years in a row, we've messed around with 1350 to 1400 and rejected it every time. So don't give me this double top, triple top shit.
No. There is no such thing as a triple top, and there's certainly no such thing as a quadruple, a quintuple.
But this is not a topping. I'm sorry,
is.
Kev. This is where you are awfully wrong, okay? Because topping formations happen at market tops, not
but that's
at
what
market
I'm saying.
bottoms.
We're headed higher.
Okay.
No, but that's what I'm saying. That we're gonna go through this, Patrick. I'm agreeing with you.
Okay. So I misinterpreted you. I apologize.
Yeah.
I apologize for getting all defensive on you.
The fact that we keep pushing up against this level.
Kev, I have to interject here, because I have to say that I've had Big Picture Trading members, as well as a few people that are non-Big Picture Trading members, reach out to me, pointing out that it appears to them that I keep shitting on you way too much during these shows.
For sure, you're awfully mean, buddy.
They see, everyone seems to love you. I'm like the odd, like the ugly duckling here, and everyone's like on Team Kevin Muir. No, stop for a second.
Not a chance. Do you know what? One second.
For everyone,
okay, I'll let you finish it, and then I gotta tell you something.
It's like, stop being so mean to him. He's such a nice guy, you know. But listen,
okay, well,
I take pride in keeping you honest, and I hope that one day you can shit on me for being wrong, which is.
So, Patrick, I will tell you one thing. You might find that people are saying that, but I'll tell you that there's a lot of people on Twitter that will agree with you about how much of an idiot I am, and that you should continue roasting me. Because my bond call has been wrong.
Yeah.
My stock market call, although I have been bullish, I still contend I'm shocked that given how badly everything is gone, that we haven't been lower.
Our listeners, just have to know is we've cracked open a couple beers and we're having a great time. And shitting on each other is a part of the show. If we didn't do it, you wouldn't be entertained. We're good.
You're still kind of a jerk. Let's face it, Patrick.
That's what my wife says all the time.
That's right. Well, mine is too. So at least we have that in common.
Anyway,
no, the reality is that we are good-natured about it. We are, listen, for those that are worried about it, don't worry. Patrick and I are still good friends. We even though he gives me a hard time, it's because he's not smart enough to realize that eventually I'm
choking on my beer.
And it's going to be funny. Listen, while we're talking about this, let's just have a little moment aside. We're going to have the grand debate.
Yes.
At the Chicago Trader Summit.
Expo.
Or what is it? Expo?
But listen, we're going to talk about it because we got John Netto coming on the show. And
right, we're going to talk about it next week. But listen, I do want those to know I'm going to destroy him. And he's like, it's going to be ugly. And the reality is that, he can talk
when I'm on that stage, I'm going to put together the case that is going to unravel everything at the seams for you. You're not even going to know what to say.
So listen, when you kind of photocopy Lacey Hunt's thing and then can't argue it correctly, we're gonna have some troubles. Anyways, let's go on. Really good. Whoa! Actually, one second. Actually, I wanted to talk about this because I recently I've been a gold bull for a while, and I'll tell you why I was a gold bull. Because I said to myself that either bonds are mispriced or gold is mispriced. One of the two is wrong.
Okay.
And I'm willing to say maybe I'm wrong about the bonds. Lord knows everyone on Twitter tells me I am. So maybe I'm wrong. But if I'm wrong about bonds, then gold should be much, much higher.
Fair enough.
Because we go look at like the 5-year TIPS yield.
Yeah.
We're now back to 23 basis points. We were 120 basis points kind of in December. You know, that's like almost 100 basis points of real yield that's compressed on the 5-year.
I mean,
basis.
that's huge.
And I think that's it's huge. I think that one of the things that if you're going to take away anything from this market huddle, it's the fact that this point, equity traders and in fact almost all other asset classes are not appreciating the magnitude of the recent bond move. It is unprecedented. It is huge. It is going to affect all other asset classes for a long time coming.
And it's not over,
and
Kev.
Yes,
and it's not over.
Okay, whatever. Regardless, I don't care. Like, maybe you're right. But I think that in the meantime, stuff like gold is going higher. Now, so I've been bullish on gold for a little while. I tweeted it out that I felt like when the bond move happened, I said I don't own enough gold. And I immediately went and bought some gold, and it's kind of I've been lucky enough to get that one right. It's nice to get one right at least. And recently I've gone and I've switched to silver.
Yeah.
And people ask, don't ask me why, because like this is one of those spidey sense things.
Well, I'll tell you. You know what was fascinating? So we had Adam Collins on just the other week. And I invited him onto Macro Voices, and he put on some COT charts. And you know what? The COT reports are showing the speculators to like the 0 percentile on the 5-year. We have extreme COT reports. Like the speculators are on the wrong side of that deal, and so that makes it really squeezable, doesn't it?
Well, are you talking about silver or are you talking about
No, I'm talking silver.
Yeah, I think that silver. I don't know.
It's squeezable. It's squeezable.
I don't have any fundamental reason why I should like silver. I'm sitting here staring at the charts all the time. It feels like
I got to pull this up. I'm going to pull up the silver chart. Hold on a second.
Yeah. I am not a squiggle guy.
No, we're talking about COT reports, not squiggles.
No, but like I'm telling you, that's why I'm buying it. It just feels better. And not only that, go look at the gold-silver ratio. And this is like,
all right.
One of the things I have a confession to make. Wait, 1 second. Oh, okay. Speculators are short.
Yeah. To the 0 percentile.
But a bunch of idiots.
Like producers. Like it's nuts. Yeah. Like so it's a squeezable market. Like the specs, it's crazy. Like like Adam said it right. He was saying that you can't overread commitment of traders reports week over week. You're looking for points where there are extremes, and when you look at the actual COT numbers, so this is not looking at it in the way that Adam looks at it, but notice here that we went from commercial hedgers being like 80,000 short back in like March to at one point commercial hedgers were net long last week.
There you go.
Like this is a complete flip. Look at the purple bars at the top. The specs went net short.
So I have a confession to make. Patrick phoned me up. We were chatting this morning, or maybe it was yesterday morning. He said something to the effect that you said, after a couple of years of getting to know you, I've noticed that you love fading everybody. And I was like, yeah, I kind of I have a problem.
You have a real problem, dude.
I do have a problem. If everyone agrees with me, I kind of think they must be wrong because they agree with me. And this is yet another example of the Kevin Muir, I got to be on the other side of everybody else. Because dial the gold-silver ratio. Can you pull that chart up easily?
Yeah, hold on.
Because if there's ever, an example of trying to catch a falling knife or the other way or selling a spiking market, here it is. Gold has been continuing
I got this right?
outperform.
Gold, silver? Is this so?
Yeah, there you go. So I am like an idiot trying to tell you that you should buy silver and sell gold, because that's in essence what I've done. I've taken my gold, I've sold it all, and I've
let's
replaced it with
flip it
silver.
upside down. This is the silver-gold ratio. So, you can see that everyone is everyone's long gold and have left silver for dead.
Yeah. So I am an idiot.
Are you? Eventually, you'll be right.
Yeah.
By
I'm not as sure as you
2025,
are.
2030, you might make your money back at some point.
I have a good friend that told me once. He says, "I'm never wrong in the markets. My timing just sucks sometimes." And I feel like you're kind of giving me too much credit. So anyways, I'm not saying I'm right. I'm just saying that I like silver here more than gold. Dial the silver chart for me. Do this final thing before we go.
Hey, dude, you know what?
I think that
this could be the beginning. I mean, it retested its lows, and it's turned up. A lot of technicians love to draw those trend lines, and they get all hard over some kind of little breakout like this. Maybe. I mean, gold's about to break the 52-week highs, and silver's still along its bottoms, right?
Yeah.
That's like a.
So listen, I might be wrong.
Yeah.
I might be wrong, but there you go.
Well, listen,
that's my call.
the value
buying
investors
silver,
buying silver over gold. That's that.
Yeah, like the idiots like me. There you go.
Your
anyways,
value.
I'm long silver. I've sold all my gold and I've replaced it with silver.
So let's talk the renminbi, and so I've often tracked the onshore, but we're talking offshore here. And what's interesting about the Chinese currency is it's breaking back down to 52-week lows, right? And now, obviously, tariffs. But this is a pegged currency. I was about to say manipulated. I'm trying to beat you conspiracy. It's obvious. Listen, PBOC manages the currency exchange.
They
manage
word.
it. Okay, they manage it.
Yes,
I should not have used the word manipulate. It seems so sharp.
No, you can
it
use
seems
manipulated.
mean. Anyway, but the point is, it's a managed currency, so it's not free floating the way the majority of the G20 currencies are. And so we're in a situation, though, it's weakening. Now, this is interesting because if this was to break down to 52-week new lows, how long do you think it will take Trump to tweet out China as a currency manipulator?
Oh, it'll happen right away.
I agree. But yet, when you put tariffs onto China, and you screw the flow of capital, the PBOC has either they're going to have to defend it by depleting their foreign exchange reserves, or they're going to have to let the currency go.
Oh my God! Here we go. So you and Kyle Bass can hang out.
No, but I'm just saying that. By
right.
putting up tariffs, what do you expect the currency to do?
I don't know. I just know that
all I'm saying is Trump is putting China in a difficult situation, which is basically if you put no tariffs, then they could defend their currency higher. But if you put up the tariffs and then complain about them being a currency manipulator, you're not going to get both. I honestly think that if the tariffs keep coming, the Chinese are going to let the renminbi go, and it's going to drop. And then Trump's going to get all flustered about this.
So here's what I think. This is my prediction. It breaks 7. All you technicians get super excited, kind of like 16-year-old boys at a Porky's movie. And then the Chinese come and flatten you all.
Oh my God.
You. Like
you really think?
You guys will get you guys.
First of all, I have no trades. So you can't flatten me.
They're gonna lay
you can't
you
say
out
flatten me. I'm only offering you a speculation with zero money at the line. I've not trading this.
Well, that's my prediction. That just when all the technicians and everybody gets excited,
you can't use technical analysis on a managed currency. Exactly. But
it's a political game. You might as well be playing.
Okay,
Go
but I
or
think that
it is.
everyone gets that, Kev. Honestly, I don't think there's day traders throwing on charts on the.
Well, no. Just wait till this thing breaks and all you technicians get excited.
I'm already excited. It made it to number one.
Yeah,
it made it to number one.
But
it made number one because I'm trying to predict as to when the Donald Trump tweet comes out. How many people, like right now, you heard it here on the Huddle first. There is a Trump tweet coming out, and it's going to be about China being a currency manipulator, and it's going to come as soon as that renminbi breaks. It's coming. Everyone be pre-warned. This is a Huddle warning.
Yeah, he's got an alert set up on the Bloomberg. I'm pretty sure.
Anyway,
although he doesn't know how to work a Bloomberg, it's probably probably a Yahoo Finance or something.
All right. So listen, you put together a parting words of wisdom for us from John Maynard Keynes. Yeah. And I thought this was brilliant. I honestly am going to steal this because this is epically good. But anyway, go for it and say it.
Successful investing is anticipating the anticipations of others.
Boom. Boom is all I have to say. Drop the mic because John Maynard Keynes is the best for a reason. Because that is true parting words of wisdom. Because investing is a behavioral exercise, and it's not about the data. It's about how everyone is positioned, and it's about how you anticipate how everyone else is going to position is where the alpha is. And Keynes nailed it, is all I have to say. Great for you digging up this quote, but I think it's great.
Terrific. That's a great way to end it.
I agree.
So listen, I just wanted to thank everyone for tuning in. Big thank you to Stevie Vicks. He's still coming up in terms of the after hours. Thank you to Patrick for putting up with me for this long. Thank you to Lena, for listening. I think she's still listening. She's going to join us for the last little bit. I always love it when Lena comes in and gives us her millennial kind of bit. And thank you, the listener, for listening.
If you lasted this long, that's awesome.
It's been a long one. It really has. And as we've said numerous times, we would make them shorter, but then Patrick and I wouldn't have as much an excuse.
We'd have to go back to our wives and shit. That'd be weird.
Yeah, so it's not going to happen. This is a lot of fun, and thank you for listening.
Listen, just a quick note. If you're listening to this as a podcast and you are missing out on all the charts and images and videos that we're showing, flip over to YouTube or make sure you register at the markethuddle.com website where you can get all of the chart packs and all the video links and stuff like that to catch up on all the things you missed that was on the podcast. Also, just as a one little plug, those of you listening as a podcast on the iTunes and other places, please rate us on iTunes, at least if you like the show. If you don't like the show, don't bother rating us. Yeah. But if you like the show and you want to rate, it helps us out to put the podcast version on the map. So if you can do us that big favor, Kevin and I would really appreciate it. And as you can also follow Kevin on Twitter, where he's much funnier than I am. And you can follow him at Kevin Muir. You can follow me at Patrick Ceresna, and you can follow our main Market Huddle at the Market Huddle. It has to have the at the front. And you can follow us. And there's any last parting words there, Kev?
No, I don't. I'm looking at this picture. And
you know what was the best was Lena's reaction. Lena, you gotta get in here. Like she laughed so hard when she saw this. You know, I know I've been working out, but I don't look like that. Like that's pretty epic. Like,
Patrick, you shouldn't sell yourself short. You do look like the version on the left.
Really? You know,
You know what? I haven't seen you in the Speedos, Patrick. You know what? Although you are Eastern European, so I do feel like I'm kind of scared to go to the beach with you because I have a feeling you might wear.
Oh,
like, the
you know what?
Speedos.
I'm gonna.
Let's be honest
I'm
with you.
intentionally gonna put on Speedos if we ever go to it. We should
Oh my
actually.
God,
You know what
that's
we
just-
should do?
that's-
We should go out to the Cayman. Like we'll go hang out with Raul and company, and we'll invite a bunch of our huddlers, and we'll get on the beach. And I'm gonna pull out the Speedos. I'm gonna pull out the Speedos.
Nice.
We're gonna be on the beach.
Listen, if you ever wanted to drive away traffic, you've done it there. So, anyways, listen. On that note, we'll say goodbye and thank you very much for listening. And we'll see you
All right,
next
thanks
week.
everyone for joining.
Thank you very much.
All right, it's time for our after hours with Stevie Vicks. So, Stevie, I want to start off and ask you. You're actually enjoying a nice, tasty beverage with us. So, what are you drinking today?
So I'm a big fan of German beer. So nice Pilsner Paulaner is what I have right now.
Nice. Is beer your choice, or are you a hard liquor guy?
Well, on a hard liquor, I like bourbon. I like
Nice.
bourbon a lot, but I mostly, do beer. In the summer especially.
Yeah, that's Kevin's style there. All right.
Yeah. Okay, Stevie, it's Kev here. I got to ask you about some things because I wrote down some of your fun Twitter things, and I got to read them to you. Quote unquote from Stevie Vicks: super fast rate hikes in 1984 and 1994 have led to the biggest economic years in U.S. history. Hike rates fast is the best way to deal with it. Slow rate hikes freeze financial markets. Get it over with quick. Do it fast and hard. I'm just going to let that one go. So what do you think, Stevie? Like, what do you think the Fed's making a mistake here by following the market down?
Absolutely. I thought most of the trouble in the market was over. I mean, our target for 2018 was 2450. So at that point, I was like, when it dropped below, it basically started to buy the market. So I thought it was totally unnecessary. Now here's the problem. What happens is when the Fed starts to hike rates, at some point it gets to a point where it starts to freeze the bond markets, right? The junk bond markets, they can't do any issuance because people are waiting for the treasuries to go up to a certain level. They can price off the junk bonds off of that, right? And then they can reopen the market. So the slow pace of rate hikes was good for the first couple years, but when you get to this critical level, you can't really do it slowly. That's why you've seen in the past the Fed very quickly hike rates, and they basically get it over as quickly as possible, right? That's what.
But Stevie, why do they have to hike so fast? Why is it so important to push the economy over the cliff and cause a recession?
Well, I don't view rate hikes as a negative, So you have to understand, there's 10 trillion in savings in the U.S., right? So you have to look at the U.S. If you look at the consumer, which is 70% of the spending, a rate cut is not always what stimulates it. Sometimes a rate hike is what stimulates the consumer spending. Now, I'll give you an example. In 2007 and 2008, most of the mortgages were at 8% or 9%, and about 40% were adjustable rate mortgages. It makes a ton of sense then to cut the rate because a lot of people had very high mortgages. If they refinance at a lower level, that opens up a lot of discretionary income out there. With my, in my case, with my house, when I did my refinancings, I got $500 more money to spend. I went and bought a car. So this definitely works. But once the rates are low, as they are now, everybody has already refinanced to a 4% mortgage. Adjustable rate mortgages are only 4% of the mortgage market now. Basically, nobody has them. So what happens now is you've pushed the mortgage rate as low as possible. So you don't really have any more benefit there. But now what happens is if you hike rates, all the people that have savings, and there's 10 trillion in savings, that adds money to the economy. So all the people that they're, that they're retired, they have pension funds, they start to make money. And that by the way, was $100 billion in 2017 with the first rate hike. $200 billion additional money in 2018. People take that money and they spend it. That was the reason why we had a good economy. When he said we're not going to do any more rate hikes, basically people, and we're going to start doing rate cuts, people are starting to cut down on their spending. That's why we're seeing a slower economy today.
Okay, so I'm not sure I buy that completely, but it's interesting to think about. But one of the things I will agree with you, Stevie, is the fact that the idea of continually pushing more and more monetary stimulus into the system in the hope to get people to spend more and more and borrow more and more
Kev,
is just
it works in Europe.
Ridiculous. Like it's just no, it's yeah, and
yeah,
that's
or Japan, right?
Like
I mean, to me, the whole thing is very silly, right? Like you look at it, if you look at the GDP, right, the investment spending is only $4 trillion, right? The consumer spending is $14 trillion. So which one do you want to incentivize? Obviously, Republicans always want to incentivize the $4 trillion spending, but that doesn't give you much bang for the buck. If you incentivize consumers, you get much more bang of the buck. So that, I mean, why do you think the Fed raises rates at all, right? I mean, if interest rate at zero was such a panacea, right? We should have kept rates at zero 20 years ago, and would live in heaven, right? I mean, why does the Fed raise rates? It raises rates because it actually helps the economy at some point in a cycle.
Okay, so Stevie, the other thing I've been just fascinated by is your argument that beating a 60-40 portfolio, meaning 60% equities, 40% bonds, is becoming easier and easier as the Fed lowers rates. You said something about as the Fed systematically destroys long bond yields, outperforming the 60-40 portfolio will become even easier. There is another lifetime return of about 30% in TLT. At that point, the long bond will yield zero and its capital appreciation will be maxed out. And then you said, I did everything wrong. I got out of stocks early. I missed the melt up. I missed the mid rally in 2018. I bought some in December, but chickened out the next day. I missed 25% stock rally in Q1. I missed the bond rally twice, yet 60-40 still can't catch me. Why don't you tell us about what you're talking about there and how you're going about beating the 60-40 portfolio?
So in addition to the volatility trading, right, I'm also kind of a financial advisor. So I offer kind of a low volatile account, kind of a 60-40 equivalent account, which has some principles about the permanent portfolio to invest in bonds, gold, depending on the economic environment. So in that account, basically, my current recommendation for people is to be have like 25% in junk bonds, 25% in gold, and about 50% in short-term treasuries, right, up to 2 years. So very defensive portfolio. So I switched to that mode, maybe without the gold, right? I jumped into gold more recently, but basically in bonds kind of around the start of 2018, right? And basically since then I've missed all of the gyrations and still basically the savings account I have has dramatically outperformed by 10% over the past year and a half. Now, the reason why I'm saying is like basically the lower they put the yields of the bonds, right? So if we go lower and lower and lower, the bonds are basically an automatic portfolio stabilizer. When stocks go down, bonds go up. The principal goes up. So as you make bonds more and more expensive and the yield goes to zero, I mean, if you have a 10-year at 0% coupon, right, that's, cash is better because the 10-year at zero, can only lose money, right? The principal can only go down if rates go up for whatever reason. So
well, I guess it could go negative.
You tell that to the German fund
yeah.
owners, right? Like that. Anyway, but.
But what I'm trying to say is like this automatic stabilizer basically loses its power, and basically then it's the equivalent of cash, right? I mean, you're better off sitting in cash, and so then basically that 60-40 portfolio, which what most Americans see, they don't see the stock market, they see the 60-40 portfolio or some equivalent of it, it's going to have a hard time generating the return. So they have one more shot to rescue the system, and after that they blow it up for the next decade of savers.
Yeah, no, I hear you. I agree with you that the diversification benefit, the negative correlation between stocks and bonds is becoming more and more difficult as rates go lower and lower. Is that in essence your argument?
Yeah. So basically, once the bonds are no longer a stabilizer, in other words, they don't go up with the stock market, right? The 60-40 portfolio itself becomes more volatile. And actually, what's going to happen then is that people are going to start to recommend lower stock allocations to reduce the volatility.
Ah, that's interesting thought. So your argument is that over time, the fact that bonds have been negatively correlated to stocks has allowed people to hold more stocks than they previously would have been able to do.
That's correct.
And therefore, as the correlation increases, the kind of the risky part of the portfolio will have to be reduced.
It has to be reduced, yeah, to fit the same volatility profile. Because people are mostly concerned about volatility, less about return.
Interesting. That's a great point. I like that, Stevie. I like that. So let's talk some VIX, will we? Are you kind of, as I grew up and cut my eye teeth trading index ARB, and we did a lot of options, and I worked for a bank, so I was always short vol. Are you kind of the same way, or are you one of those guys who actually tries to find points to go long this crazy decaying asset?
So the way I trade it is basically I have a price target for the S&P 500, and if the market is below it, I'm short vol. And if the market is above it, I'm long vol, right? So I had, I was basically short vol in 2016 and 2017, and had like phenomenal returns. 50, in 16, 70% 70% and more in 16, and 20% in 17. But then, then I basically turned bearish on the market. So I've been long vol the last 2 years. So last year was the first year when VXX had a positive year. So I was basically flat, because basically I was up 30% and was down 30%, during the rally. Then I recovered it finally at the end of the year. But basically finished flat. So this year I'm also kind of long vol. So it's been a difficult year, but that's how I play it. So yes, it's a crazy decaying asset. But if we do have a bear market, if we do finally have a bear market, long volatility is going to outperform. And based on the analysis I showed you earlier, if earnings starts to decline, right, you're going to see volatility dramatically increase in the markets. And so I think from here to the election, long vol probably will be the best performing asset.
Like, you know what? You were thinking he was going to come in here and be your friend, but I actually guess yes.
They're all of our guests
but
are our
he's
friends.
much
That's
smarter
true.
than so. I wasn't going to say that last sentence, but you filled in the blanks. But
yeah.
So generally though, what I want to ask you, Stevie, is like this last sell-off. It didn't seem to have a lot of gusto in the spikes in the vol. What's your intuition? I mean, are we still in the midst of some sort of a sell-off? Is there still one more big spike in vol coming here? Or do you think that this leg of the market correction may be over, and that something more ominous is like in the second half of the year later on?
Well, as I said, I'm actually, my target was 2450 for last year. For this year, my target is even lower. So I think the market is straight down.
So this kind of rally, you're going to fade it?
I'm totally fading I've been fading it, from the start of the year. I'm fading this round. I'm fading everything. It has not worked out very well so far. I'm down a lot, but I'm fading it. The thing to understand about the VIX is, so we had a kind of a VIX spike and everything happened in like 1 hour or like in 1 day in the start of the month. So what is happening right now is there's a lot of systematic vol selling. And so the VIX get crushed like really hard, basically every time that there's a bottom in the market, right? So that systematic selling, that's kind of Chris Cole's thesis, which I completely agree with. That's going to go on until it doesn't, right? So basically, you have all these pension funds trying to scrape yield out of it, but they'll scrape yield so long as there's yield. The moment there's no yield, they're going to step out of it, and then actually vol is going to expected vol is going to go even up. So what's happening this year? We have a lot of realized vol. This year we've had so far 5 months, 3% months plus or minus, right? Out of 6. Now, just so you know, the record is 10, and it happened like in 2008. So basically, already this year has the volatility profile of a major bear market year. You don't see 3% months every month, up or down. Normally, last year it was about 5 or 3 for the whole year, and the year before that was 3, 2017. I mean, bull markets don't move 3% a month. They move, 1%. They go up slowly. So the volatility profile is very bearish. Realized volatility is ahead of the VIX. So here's what usually happens with the VIX. The VIX tends to be subdued when the S&P 500 is above the 200 MA, right? So long as the S&P 500 is above 200 MA, the VIX is not going to be where you think it's going to be lower, right? Because people basically assume that people are going to come in. They're hedged to 200 MA. They don't feel a need to hedge below it. Once you have a break below the 200 MA, that's when the VIX is going to start jumping high.
So now in this rally has been this at least a bear. We'll call it a bear market rally for everyone to know exactly what it is. You and Brent Johnson can have your little kumbaya, Kevin. So this little bear market rally, which ensued up here, it kind of pulled everything back up. But you're in my camp, right? That this is not going to sustain. I love this. This is great. Kev, I'm glad we brought him on. He's a really smart guy.
Look at the 2015 chart, right? Look at the 2015 chart. Thank you, guys. You're too kind with the smart stuff.
All right, so here's the S&P. So you want to go to 2015?
I'm going to have another beer.
You want me to go like on a weekly chart or something here?
Yeah, look at the 2015 chart. Yeah, 2015.
So it's a weekly chart. So.
Yeah, so you see so you see how it kind of went up. You had like some drops, and you had like earlier in the year, in March, April, May, it kind of kept grinding up, and every dip got bought as it went up high, right? It kind of did this wedge, right? And so along this way. So what we're seeing right now is exactly that, right? It went up a lot, now it dropped down. It's probably going to go up to a new high or somewhere close, right? It's going to kind of wind up this thing, and you see the drop happens in the drop of the August drop happened in about third or fourth week of August. That's when you have the earnings. Earnings get reported in July, right? Basically through by that time you have like about 80% of the earnings, and that's right after that it collapsed when the earnings picture for the second half becomes clear. So I think very similar thing will happen this year.
So, Patrick, I just want to say one thing. If Stevie's right about the Democrats doing as well as they're going to do, then we are going to have some trouble, because I agree with his analysis that they are, especially if we get a real left-wing kind of, I don't know, who are the most left-wing of the Sanders. I think there's even worse than Sanders out there. But if we get one of these kind of crazies, left-wing crazies, that are going to roll all this back, roll back the tax cuts, can't even speak, too many beers into it, and then the market starts to figure this out, the stock market's going to have a lot of trouble. So listen, we're traders. About me being bullish. I am bullish, but I do agree that if the market starts to sniff out a Democratic win, then we will get into trouble. The only thing that I'm not sure about on Stevie's call is that I'm not sure the market figures it out as quickly as I think he's giving them too much credit.
Well, they're
going to figure it out. Sorry, go ahead, Stevie.
Yeah, so you have to look at 2007 and 2008, what happened. So if you remember, the market topped out in 2007, right, in about October, and after that it was straight down for 2 years during the Democratic primary. And, the market really collapsed after Obama was crowned as a Democratic nominee. So the market is going to start to struggle. As I said, like this summer, you could still have some upside, but then in the back half of the year, it's going to start to really start to think about what happens in the next election. And that's when you're going to start to see this thing being taken more serious, the polls being taken more seriously, and so forth.
Okay, so actually, one thing we haven't talked about a lot, Stevie, is your inflation outlook. You went over it early. You gave a very great argument in terms of why minimum wage is going up and why we're going to see more inflation. And I think I've seen you on Twitter talking about how the year-over-year comparisons with the oil increasing are also going to kick in. So on the whole, if I'm correct, you foresee increased inflation numbers going forward. Yet right now, the market is kind of anticipating the exact opposite. How do you think that resolves itself?
So the inflation, basically 30% of inflation is the energy prices. So you have oil, went down at the end of the year, but then it went right back up, right? So now it's down a little bit, but I think it's going to recover at some point. So even where it stands right now, oil is up about like 30% on the year, right? So you have 30% going up 30%. So that's going to add you about a 1% to the CPI, right? Now, the trend CPI, the core CPI, because of the wage increases and the raise in rents, right, it's going to remain pretty strong at about 2%, right? So then,
and we also have the tariffs, right? We have tariffs. Like on the whole,
that's right.
I don't see I see inflation everywhere. And I might be like that kid from Sixth Sense where I just see dead people everywhere, but I really. I see inflation everywhere, and I think we're in the same boat. So I'm just having trouble reconciling how the Fed and how the market is pricing in all things fixed income.
Well, yeah, don't go to McDonald's because you're going to have a headache. How much a meal there is, but it's when the government tells you there's no inflation, right? When the government denies something, that means there's a problem.
Yeah.
Right. If the government telling you there's no inflation, that means inflation. We have pretty strong inflation. But you will see the reading strengthen. I think what the Fed is saying is that this strengthening in the reading is transitory, right? And so that means they can kind of keep the rate low or cut rates a little bit and look through it. But as I said, given where the wages are going, I think the Fed is going to make a mistake. And if you've seen in prior cycles when the Fed has cut rates, so they did that in 98, I believe, right? Immediately after that,
right.
Rates they had to go up even higher because to contain the market bubble. The same thing happened in 2004. They had a couple of extra cuts there. To help push out, that triggered a housing bubble, and then they had to really raise rates really fast to contain the bubbles and the inflation.
So Stevie, how do you not worry about that part of it? Because I'm 100% in your camp that is what might happen. But doesn't that imply that stocks go higher, or at the very least, like the Fed is sowing, is planting the seeds of the next kind of bubble in risk assets?
Well, inflation is not good for stocks, right? I mean, when you have higher inflation, basically earnings go down. And so what you see is like we have a period where stocks go sideways, inflation goes up. I mean, really the best thing to do there is to be in short-term treasuries. And then unless the Fed is doing something like fixing them to zero right now. But
what if the Fed does? What if the Fed leaves rates looser? What if the Fed allows the economy to run hotter for longer?
I don't think they can do that because the banks are they're gonna have to raise it for the banks. I mean, rate goes up because the banks become insolvent. Now, if you have a democratic government and they say, okay, the banks are going to go insolvent because, banks can't run at rates below inflation, right? I don't think the answer is stocks. The answer is gold. The answer is, the answer is gold and, hard assets. You basically have a devaluation scenario, right? I've gone through a devaluation scenario. Where I come from, hard assets and gold is basically the only thing, real estate, that's the only thing that does well. Businesses don't.
Well, okay. So I think we're on the same page there. I do agree with you that hard assets will outperform stocks. So I'm not as much as I think that stocks do better than the bears believe. I do believe that hard assets will do better because the Fed will be fixing rates below the rate of inflation. So what do you think happens to gold if what we're kind of envisioning, with the Fed keeping looser for longer? Like, where do you see that going? And the other thing, the next part of the question is, you're recommending 25% of the portfolio in gold. That's a huge allocation. That's like Jim Rickards would be scared about that.
Yeah, I mean, this is kind of a sample portfolio. Basically 25% is my what, so I keep it simple. For things that you want to be looking at. So something I want to mention for the next cycle is basically what's going to happen is investors are going to start to go into things that have preference over stocks. So I really think stocks are in big danger because basically when earnings go down, right? You have to focus, investors are going to focus on the capital structure that gets paid first. And that's investment grade bonds. And then after that, junk bonds. And then after that, there's going to be no money left for the stockholders. Okay. So that's why I like, I think in that scenario, you want to have junk bonds, they'll pay a high coupon, maybe higher yielding liquid bonds, investment grade bonds if you can, and also gold, right? So if those goes down in value, the gold will offset the principal. But gold based, the way I value gold is based on the size of the balance sheet. So they were at 4.5, 2,000 gold. When they said it's going to go to 2.5, my gold projection was for about $1,000, right? So now they said we're going to go to 3.75 or something like that. That means the gold price should be around 1,600. Now, if they start to do these other experiments, now yield curve control, keeping the short rates at zero and all that stuff, I don't think these things can happen as easily as people think. And I think in the next recession, the Fed is really going to look. So one of the things I need to mention is all the reviews of Fed monetary policy have said that basically the QE, what the Fed did, was not very effective in suppressing long-term rates. So their goal was in 2008 was to suppress the long-term rates so people can refinance their mortgages. And instead, what happens, and this is, John Taylor just had a presentation about this. Instead, what happens is the 10-year rate just went up, right? So
right.
The QE has been deemed a complete failure. So what the Fed is instead going to do in the next time around, and they don't have as much money anymore, right? Because debt to GDP ratio is hard. They have a bigger balance sheet now. They're just going to focus on the long-term debt, try to suppress that to get people to refinance, right? So they want to. They probably want to have a flat yield curve, but it's not going to be at zero. I think they want to have a flat yield curve at 2%.
Okay. Well, that would be terrible for us guys that are long fixed income volatility. Anyway, Stevie, it's been a pleasure having you. Why don't you just tell people again where they can find you and where they should follow you on Twitter?
So again, it's at vixcontango.com. On Twitter, my handle is @vixcontango. So be careful because I make my opinion.
The disclaimer: be careful.
It's not for everybody.
I can definitely attest to that because you've over the years. I think you and I met originally on Twitter, and you gave me a hard time about one of my views, and I was like, there's Stevie. I can always count on him making sure that he keeps me honest, and that's always what I appreciated. And it's been a ton of fun having you on, Stevie. Thanks very much for coming.
Thank you guys for having me.
All right, Steve, I got to ask you before you go. So you said talked about buying gold, and you said where I'm from. So where are you from? Like, where did you experience all of your opinions on gold and everything?
I'm originally from Bulgaria,
okay.
Which is Eastern Europe, and I came here very young as a teen, in high school.
Right.
So I lived in the United States for 30 years.
Right.
But in the 90s there was when communism fell down and we changed to capitalism, there was kind of a period in the mid 90s where there was basically massive currency devaluation. So everybody lost their savings. My grandfather, everybody that had any savings lost everything.
Wow.
And people like my father who were in business who had hard assets. So I'll tell you a story of my father, how he got rich. He was importing air conditioners from abroad, right? So he got out this huge loan in the Bulgarian currency, right? And he bought out this massive amount of air conditioners, and then right at that time they do this currency devaluation. So his debt, 1 to 1,000. So his debt goes from from like $1 million to $1,000, right? I mean, completely. So he then after that he sold one device and then
His
paid
debt
off
was
his
paid off. That's fucking
paid
amazing.
paid off. So he
Those
got
are-
rich, but but my grandfather lost all his savings.
All right, so Stevie, thanks a lot. It was a great interview.
Thank you guys for having me.
Okay, so Lena, what did you say about Patrick? What did you say about Patrick about these pictures?
Well, first of all, I thought it was almost as good as the picture that you had a few episodes ago of your macro tourist picture that you're.
Oh yeah,
The
when
lightning
I was,
strike?
with the lightning. The lightning?
That's
Oh
almost
yeah,
as
that's
good.
I agree.
Also because I'm thinking, I was saying to Patrick, I was like, oh, you should just superimpose your face on there, and then I thought, wait, no, I don't want to see that. So maybe not.
Yeah, I don't want to see it either.
But I was actually
That's just
caught up on when you
bad.
guys were talking about the Me Too movement, and I was like, somebody was talking about, it's hashtag Me Too, right?
Yeah.
But somebody was like, what is this pound Me Too? Obviously,
That was awesome.
Oh my God,
Pound me
Lena,
too.
you're-
That's the pound
You're
me
like
too
the.
movement.
You're like the. Oh my God. Pound
There used to
me
be a
too.
pound button, right? When we used to I don't know.
That's
Oh my
awesome,
God,
isn't it?
Lena,
So somebody was like, what?
Lena, you are the worst millennial
Yeah.
ever.
But
Like the fact that she's like, what? You want me to pound me as well? Is
No,
that what
pound
you're
me
doing?
too.
like instead of hashtag
I know,
Me
but
Too,
she's
it's
like-
what is this pound Me
Yeah.
Too? It's just like.
I kind of like Chris Pratt though. Like you got to kind of like this guy. He lived in his in his van in Hawaii for a while, right?
Oh, I don't know.
No, I
You
did
know
not.
He's like
Yeah, he
he's
just
like
lived in
engaged
his-
to Arnold Schwarzenegger's daughter, I think.
Really?
Yeah.
No.
Yeah,
Is he-
yeah.
No, you're
Yeah.
wrong, Lena.
All right, Google it.
Okay, listen, Lena, I'm sending you the picture right now. We're gonna include it in the thing, so you can put it in the up on the screen right now. But no, you're wrong. I'm pretty sure he's engaged to that woman that's kind of funny.
they're
but,
divorced.
Are you saying Arnold
She
Schwarzenegger's
got
daughter
divorced.
isn't funny?
Oh, really? He got divorced. Oh, I don't know this. You were like way ahead of
See,
me.
you're like way behind the
Okay,
times.
let's look at. Yeah, I don't really know
You're-
these things. Let's
You're
look
too busy
here.
staring at yield curves.
Anna Faris. Is he not married to Anna
Yeah, like
Faris?
years ago, and then they got divorced, and now he's like engaged or dating or whatever with Arnold Schwarzenegger's daughter.
Oh, you're right. Catherine Schwarzenegger. Here we
Yeah.
go. See, this is why we have a millennial on staff.
And no,
This is
his
why.
name sounds like Crisp Rat.
Ooh.
Yes. So let's have a look here. Let's see if he did an uptick or not. Who is she? I don't even know her.
Arnold's daughter. What more do you need?
So she's really a Kennedy almost, right?
I guess.
Because he married a Kennedy.
I guess.
Oh,
so,
wow. This is just getting all messed up, man. Next thing you know, he's going to be like the president of the United States. You just watch.
Yeah. It's possible.
I'm
If
calling her right
Arnold was
now.
a governor, I mean, it's possible.
Yeah.
But
Guardians of the Galaxy. You got to love that
Yeah.
show. Out of all the shows my kids make me watch, that's one of my
Really?
favorites.
I'm not a fan
Oh,
at
yeah.
you mean
No,
the
no,
movie?
but I
don't
like
like
him as
it?
an actor, but I don't like this. I don't like the movies. No. That
Patrick,
old
you're-
Groot shit
Yeah,
and
but
all that
Kevin,
stuff. Like,
Patrick also likes sour beers, so
oh,
kind of.
I do like sour
Yeah.
beers.
You're
When
just-
I've heard the sponsors send
Okay,
us
so
those,
Patrick-
I'm more than happy to get them included in the show. That's, you know what, the millennials that like sours,
Yeah.
they're in my camp. I'm good. I can drink a sour.
Have you looked at the soundtracks for these things? And then a
Groot?
or whatever, the
Yeah, the
Groot or
little
whatever.
tree
What
thing?
is the.
Oh, he's horrible.
know.
And the raccoon thing, that turns me
Oh
off
my
right
God.
away. Like, I'm just not interested.
Patrick,
I
you're
am.
like the
I am.
worst,
It's not
buddy.
good. It's not good. Modern Hollywood has
listen.
gone down the toilet.
You know what?
Are you guys gonna watch the
Oh.
game tonight?
Yeah, the Raptors. No, that's
yeah, I
awesome.
was like sitting here, like waiting.
You know,
for
did
guys
you end
to
up
wrap
making
up.
that? Did you make that bet with Brent Johnson?
No, so I did not make the bet.
And now
with
he doesn't
Brent
want to make the
Johnson,
bet
and
with
now
you
we're up-
because
What about the finals?
We're up 2-1.
well, Brent Johnson's down in,
Yeah,
San Fran,
San Francisco.
and so
Yeah.
like he was kind of goading Kevin to make a bet, and like I would have taken the heartbeat, but like I just chickened out, right?
Well, you should have
So what
done
was
it,
the
buddy.
bet
I
that-
fell down. I was a mope. I don't know anything.
Well,
about
I mean, you just have to
basketball.
make
I
a
don't even
gentleman's
know,
bet.
I know, but no, it's not really like that's no fun. We had to do something embarrassing, and I wasn't sure whether like I saw the Las Vegas odds. Listen, this is how much I know about basketball. I see them, I watch them. They go, they charge for the net or whatever it is they do, and all of a sudden the whistle blows, and I'm like, "What do you mean? That looks like a clean hit to me." Like I don't.
Too much hockey on your brain.
I don't understand.
That looks like
I
a
just
clean hit.
don't
Like
understand.
He took the shoulder right into the chest there. That was clean.
I understand. Like I've said it before. I am like, you know, when they took hockey down to Florida and they had to like tell the rules to the Americans, like the Southern Americans. That's like me with basketball. I'm useless. Like, you know, they might talk about Toronto being a great basketball city. I am not your guy. I grew up in Winnipeg.
Oh, right.
We
You were
played
working in
soccer and hockey, and that was it. So I don't know anything about basketball. I am super proud of our city. I hope we win, but I don't like. I'm not prepared to go bet on it. I don't have
hope
a
you
clue.
guys
What are
not
you
down
prepared
bad.
to
We
bet
win.
on it? Just bet on it. You got to be a risk taker.
Well,
You have a.
I think you should bet on it with Brent. I think you should.
If he gave you
Well.
the Vegas odds spreads on that, then you should have taken that in a heartbeat. That was just stupid. I mean, it was
I
like
know,
plus
we-
300 at one point at one on the Golden.
I
Like,
know.
it
I fell down. Patrick, you should get. You know what your problem is? You're not as good on Twitter.
Oh, you know
Patrick.
what? I'm
You
gonna
barely
see
look
whether
at
he
the
still
thing and
gives
stuff.
me some sort of odds. I'm gonna reach out to him
Okay.
and I'm gonna see.
So let's go. Yeah, do it right now after we're done and say, you know what? You know, Kevin and I were talking, and we fell down on the bet. I really think that we should do something with our Chicago presentation where we have to wear like Raptors or not Raptors, Warriors or whatever their team is called.
Yeah,
whatever
but
that stupid
where's
team is
Golden
called.
State Warriors.
Like what is it called? Golden
Yes.
State
Yeah,
Warriors.
Golden State Warriors.
Like we have to wear like big fingers for 5 minutes of the presentation if we lose, and then we'll
If
find
you
out.
win,
what
if
I
we
would really
win, you
like.
should get a T-shirt made that says Kawhi Mia River. Kawhi Leonard is the key player on the Raptors team.
Yeah, no, I know. You know what? I might be useless at basketball, but even I know.
Well, there
who
you go,
he
King
is.
of the North.
But I think though that one of the things that we should do is make Brent get on Real Vision and say something. But I don't know if Real Vision
Yeah.
will go for it.
Maybe not.
Like make
He
him wear a
wouldn't- he
hat or
wouldn't.
something like that.
Well, you know what? I'm gonna
Yeah, I
call him
know.
up
He's
and
kinda-
ask him. Let's see. Maybe we can make something happen.
Okay.
All right, I'll call him. We'll see.
Yeah.
There's room. There's
There you
always.
go. Well,
Maybe Gorevich will be in. He's also on San Fran. Maybe we can get him to make a bet. Yeah.
Oh, is he really? I didn't realize he's
yeah,
from
but
San
who knows
Francisco?
whether he's a fan? But
If you guys are gonna bet, you guys gotta bet like now before game.
no, of
4.
course. I'm gonna have to. I'm gonna see.
Wow.
Well, let's. I'm gonna just
You're
reach
the
out on
Goocher.
Twitter, and
Well, so the other issue is that I was worried about betting on it because I didn't want to gooch our team because I figured I've been so cold lately that me going out and betting on the Raptors might lose, and then I would have like a horde of people on my doorstep saying it's all your
oh,
fucking
you know what?
fault.
You made the safe
and
bet.
I just
'cause
I just
you
wasn't
made the
ready
safe
for it.
bet. That's actually, in hindsight, you're actually good choice. Good choice.
Bad
Yeah,
karma.
because you know how cold I am
no,
these days.
you don't, because you know what? Like you look at the
Like-
flack that Drake is taking in before they got
Yeah.
hot. Like you don't want to be like put a Drake curse
Yeah.
on the team.
Well, fair enough. And you know what? If I bet the sun wasn't going to come up tomorrow, I think we would have
50-50.
like a total eclipse for the
It'd be a
whole day.
50-50.
Like that's how cold I am these days, Patrick.